informational purposes and not.
เ Everybody, just about the host. That's it.
What's up, everybody? Welcome to today's session. We have an amazing session planned for you today here with Matt Maley, Chief Market Strategist, guys. And in the chat, go ahead and let us know where you guys are tuning in from what part of the world you guys are checking us out. And also let us know what stocks you're trading, what kind of stocks you're looking into. And let me know in the chat, guys. Let me know when you're ready to start. All right. Let me know when we will be ready to start. As soon as you guys are ready and you tell me in the chat that you're ready, we're going to start. Okay. And that's when we're going to bring on Matt Maley and start going over the discussion here, guys. LA, Toronto, Sacramento. And we're going to close this timer here, guys, because I think you guys are ready. You're getting a little ready. I feel it. Florida, California, KC. All right. Looking at Intel, AMD. All right. Cool stuff. Cool stuff. All right. So I think Matt Maley is in the house. Let me get some confirmation. Ukraine. All right. All right. All right, guys. You're ready. I see it. Let's do it. We're bringing on Matt. We're bringing him on.
Okay, you got me now, bud? Sorry about that.
Hey, how are you doing, sir? How you doing, Mr. Matt?
Good, excuse me, Rodrigo. Good to see you, as always.
Good. Same here, man. Same here. Absolutely, man. It's a pleasure having you here. For those that are not familiar, Matt Maley, 40 years in Wall Street, Merrill Lynch, Solomon Brothers, current chief market strategist at private equity firm Miller Tabak. So glad to have you here. I know some people might know you from, seeing you on CNBC or Bloomberg, some of those places, but we do appreciate you being here with us, Matt. So what's going on your corner there?
Well, it's, obviously we've seen a big pickup in volatility again after a very short respite between Christmas and New Year's. And even then we saw some movement there that week. But yeah, it's going to be a real exciting year this year. We have all sorts of things. I think is going to be a real change, a year where those, we've heard a lot about being a stock pickers market this year. I totally agree. If you sit there and buy the mutual funds and just sit on them, it's going to be a tough year. You may not lose money, but it's going to be tough to make money. And I think there's going to be some unbelievable opportunities with this volatility to make a lot of money, and especially for individual traders who have never been able to make it in down markets. I say the market's going to fall out of bed for the next 5 years or anything like that. But I'm just saying that, in the past when we've had serious declines or bear markets, the individual trader had nothing. I mean, you could buy options, some put options that went out, quarterly options that went out several months, but those were expensive. Nowadays, we have inverse ETFs, we got inverse leveraged ETFs, we have call options, put options that expire every week for all of the big names and for a lot of the medium-sized names. And then we have options, put options if you want to bet or hedge yourself or bet on the downside on the three big index ETFs that expire 3 times a week. So you can just have to go out a couple of days if you want to put on a hedge. And it's a lot cheaper to do it and a lot easier to do it because most of these assets are very liquid. And again, this is something that institutional investors have been able to do for decades, because they could just go to a bulge bracket firm and say, hey, I need an over-the-counter put on the S&P 500 to protect me for the next month or for the next 2 weeks. And they'd sell it to them because they had enough size. They'd pay a big commission, and the firms would sell it to it. for individual investors, it was such a small thing. They pay such a small commission. It wasn't worth them, writing that over-the-counter option. But now they trade on the exchanges. They're very liquid, and it's going to really create some great opportunities in 2022. It already has this week. The one thing I want to just talk about, just to start a few things here. I want to talk about, first of all, who I am and what I do and what I've been doing and why you hopefully will want to listen to what I have to say. But number two, we want to talk about why why I think the market's going to be so volatile and what's going on in the marketplace right now that will create what I think is going to be a deep correction or even worse before the year's over. It's interesting. Although tomorrow it's going to be funny because tomorrow morning I think there's a good chance we get a bounce in the market. And we have in our tier four chat room, excuse me, we got the Benzinga stock pickers report with tiers 1, 2, and 3. But we also, excuse me, let me just take a sip here.
Yeah, if you want, go ahead and take over the screen as well, Matt.
Yeah,
so
okay,
that
great.
You can show them, get your terminal pulled up and stuff.
Okay, let me get here going. Okay, now, so yeah, just to give you an idea of whoops, what happened? What happened now? Hold on a second. There we go. There we go. Okay, slideshow, bang. Okay, hopefully you can see. This is kind of my little presentation, but we'll bounce around because it's got 40 slides or something in it, and I don't want to bore the heck out of you guys. But the whole idea, again, tell you what who I am and what my background is, and number one, number two, and then give you an idea of what I think is going to happen this year and why I think it's going to create some unbelievable opportunities. So just to whoops. Why is that there? Okay. Anyway, my background, as Rodrigo mentioned, I've been in the business for almost 40 years, but the first 25 of them was on trading desks. The two of the biggest trading desks in the world, and most strategists nowadays, they basically all of them are either an analyst or or economist, and that's fine. But those people concentrate on very long term, and they also spend a lot of time on what should happen. Where traders who have a more short term orientation, maybe just a few days, a few weeks, a few months at the most. They're concentrated much more on what is happening, not what should happen. And we know that one of the worst sayings on Wall Street, and people say it all the time, is the market is always right, and that's ridiculous. I mean, the market is only always right eventually, and name any time. In March in 2020, when the market was down 35% due to the pandemic, was the market right? No, the market bounced up strong. Was the market right in 1999? Of course not. It was way ahead of itself. So this is what we're trying to do. We're trying to go in there as a trader, use the tools, use that fundamental analysis. That's very important. That theoretical stuff that gives you that long-term view. And of course, you want to invest your have a big bucket of money. For some people, that's all they have. Just have a big bucket of money that there's one bucket of money, I should say, that they just let sit there, and it's long-term, 5-10 years, and for younger people, it's 30 years out, and that's fine. But for others, they like to have that one that's really kind of that long-term thing. And like, for instance, Microsoft right now, which I think, it's been under some pressure lately. I think we'll go lower, even though it's a great company. And I'll go into that later. Is a great company, and the stock will do great longer term. You shouldn't be selling your stock here. But for those of you who have another bucket and where you have more active trading going on, you can trade around, especially in the options market, and really maximize those returns. And we'll see what happens. It's funny, even though I'm concerned about it over the next couple of months, we do have in the chat room last night, we put, I'm sorry, I say last night, late in the day today, we suggested buying some call options in them, because I do think there's a good chance that we'll see a strong bounce tomorrow on the stock. But again, we'll go on over that in a little while. But like I said, is I worked at Solomon Brothers, and if you're younger and never heard of them, they were one of the most powerful trading desk on Wall Street in the 70s, 80s, and 90s. I was there in the 80s and 90s until they got taken over by Smith Barney, but eventually got taken over by Citigroup. But the point is that at that time I talked to the biggest mutual funds the biggest hedge funds, the biggest insurance companies, whatever, talk to those trading desks, and we learned what is going to happen on a short-term basis for that active trader, and that theoretical stuff. And one of the things that we really talk about is that there's so many things that go involved besides those fundamentals, which are very important. But you get technical analysis, and I'll talk a little bit about that, about why technical analysis is very important. That all of the biggest, most successful hedge fund managers, maybe not necessarily the long-term mutual fund guys, but the hedge fund managers, they all use technical analysis and use it every day. I'm not saying it's their number one determinant, but they use it every day. And the reason is it's supply and demand related, okay, on a short-term basis, and more importantly, it is fundamentally related. And I'll go over that in a little while. So it's important to use, but also positioning and sentiment. And I mean, one of the best calls I've made in the last 2 years was 15 months ago when I started pounding the table on the energy sector, when everybody on Wall Street hated it. Everybody, buy side, sell side, no matter what it was, they all hated it. Fossil fuels, they're worthless. Why would we buy these stocks? And my point was that I agree, we should get away from fossil fuels, but it's going to take at least 2 decades, not 2 years. Okay. And these stocks, and so I looked at the fundamentals, they were inexpensive. People, a lot of the fundamentalists said that doesn't matter because their prospects aren't any good. Well, I looked at the supply and demand situation and saw that it was actually is good. And we found in the last year, the IEA, International Energy Association, is looking for fossil fuel demand to stay near within 5% of pre-pandemic levels until the end of the decade. So this is not going away. So why not take advantage of it when it comes along? So I looked at the fundamentals. I looked at the technicals. The group was ridiculously oversold, and so were the individual stocks. Then I looked at the sentiment, and I looked like the futures traders. The sentiment was like 8% bullishness. 8%. Basically, nobody was bullish anymore. Okay. I looked at the positioning in crude oil. Everybody was short. The futures traders, they call them the speculators, the dumb money, they were huge. Everybody was on one side of the boat. No matter what the long-term fundamental outlook for the next 20 years is, this group had nowhere to go but up. And guess what? It has rallied in a huge way. Nobody made that call until January, when a couple of the big Morgan Stanley, Goldman Sachs finally came in, and they're patting themselves on the back. Hey, these stocks are 50%, 70%. That's great. I'm up 100. Well, the ETFs are up 150%. Since I bought them, because I got in there at the key turning point. That's what trading helps you. We like to go long-term key turning points like that, and also short-term key turning points, like I think we're going to get tomorrow in the market, and I'll tell you why again later. But the point is that I'm a very unique background, and that's why people it's still these these institutions I just spoke of are still paying for my services to see what is really going on in the marketplace, and it works out very, very well. Again, I already talked about that, combining these returns with all this. But one of the things we also do, whether it be in my market letters, but especially in the chat room that we just started about 6 months ago now. And we're talking about things every day, all day long. And not only am I giving ideas or reacting to other people's ideas and telling them what I think, good, bad, or indifferent, because sometimes I say, I'm decidedly neutral on this thing. You can't make things happen sometimes. Sometimes people try to do too many things when there really isn't anything to do. But the key thing is to educate investors. And we talk about these, why I like a stock. Why do I think it's going higher? Why do I think it's going to roll over? Why should we buy, even though I like it long term, let's wait until it gets to this level before we get aggressive and buy call options. Or why same thing on the other side. Why I don't like the stock, but until it gets to this level, we don't want to buy put options. And then when we do, we jump on it. Those are the types of things we're talking about. Because if you're just getting the ideas, that's great. But let's face it, you want to know. You want to know why you're doing something. It's your money. Just taking some guy's word for it is not always necessarily the best thing to do. In fact, it's frequently not the best thing to do. And when at least when you understand the idea and understand the thinking behind the idea, it gives you more confidence to make the points or to skip it. And then people have said, and I've written in things said, I want to do this here, and people saying I wouldn't touch that with a 10-foot pole. That's great, and that's the whole idea. I'm not. We go in there, we try to educate people. We all educate each other. There's no such thing as a stupid question. Some of these questions that come out, we love those questions that from people who are very smart people, but they may not necessarily have experience in certain areas of the market. And feel free to ask questions. Nobody on that site will make you feel stupid. In fact, they'll do all they can to, including myself, especially, to help you feel welcome. So it's an educational thing so that, longer term is something you're doing on your own. Again, we as I talked about it, we have to look beyond the fundamentals and really get these things. But this is what I do. We just the whole idea of what we're talking about is to make educated guesses. I'm sorry, educated decisions, not just guesses. It's so, especially when we see this big volatility. Somebody sees a stock move up, 2 days in a row and say, "Oh my God, this has got to go higher." And in some cases it does. Some of those meme stocks went up for several days in a row and they made a lot of money. But more often than not, especially if there's no short interest or there's some kind of real catalyst to push it higher, the stock rolls over. No, even if it's going a lot higher over the next 2 weeks, 2 months, 2 years, it can still take a pullback. I mean, and when of course I say all the time, Amazon has changed the world. Okay, changed the world over the last 25 years, and it's made people millions and millions of dollars in the stock, especially long-term holders. However, it's also seen 24, just in the last 10 years, 24 corrections of anywhere from 20 to 60%. And let's face it, it fell 90% when the dot-com bubble burst, even though their revenues were going through the roof. The reason is that those stocks, when really great stocks get too far ahead of themselves, people chase them too much and they have to come back down to earth. And it happens several times. We've seen it with Bitcoin. We've seen it with Tesla. We've seen it with Amazon. We saw it with Apple, Microsoft, you name it. All those great companies see pullbacks along with their big rallies. And we want to be able to take advantage of them because I think this year we're going to see a lot of that kind of volatility, more than just over a day or two. And buying the dip, every little dip is not going to work as well. We're going to be able to ride some bigger declines and then buy the dip, rather than buy the sell-off rather than just a small dip. And the whole main thing is because of the Federal Reserve. Now, again, I think we're at a key turning point right now, and that's why I really want to talk about why what's going on in the marketplace. And number one, I mean, the number one thing is the market is very expensive, and who cares? Market being expensive. That's been a lousy timing tool since God was a child, right? But we have a situation now. Again, it's trading at more than 21 times earnings, or at least it was at the beginning of the week. More than 3 times sales. That's the most expensive as it ever been. Now, PE is price earnings ratio. Okay, the PE, okay, that can be fudged because people have, they have write-offs and tax things, all this other stuff. Your revenues are your revenues. Your sales are your sales. Unless you are flat out lying, you cannot fudge them. So this is on that basis, it is the most expensive ever. And it's also the most expensive ever versus the market cap to GDP, which is Warren Buffett's favorite valuation measure. But the point is, we are getting to a point where we can time it, at least to a degree, not to the exact day, but we can time it a little bit because the Fed is changing their stripes. They are going into tightening mode. It was funny. One person today said, if you're under 40 years old, you've never seen the Fed tighten. That's actually wrong. The Fed did tighten in 2018, and sure enough, it did cause a correction of a deep correction, basically at 20%. Just I think it was 19.8% or something. So it didn't quite get bear market territory, but it was very deep, and that's what's happening now. And one of the things I worry about, why it won't be, the fundamentals are still okay. The problem is the Fed, because they pushed that huge amount of liquidity and stimulus into the marketplace, which they needed to do. It was the right thing. Okay, in March 2020. So people don't realize how the system wasn't in trouble because the banks were about to go business. The financial system was in trouble because it was about to freeze up, because the economy was freezing up. And so the Fed had to do something, and they bombarded, along with other global central banks, bombarded the world with stimulus. Of course, we got fiscal stimulus a couple months later from all over the globe. This was the right thing to do because we had an artificial situation. It was not mismanagement that caused this, that caused the dramatic slowdown in the economy. It was kind of once in a generation type thing, and so the Fed did this, and it's great. But the problem is, they pushed the market up to a certain level, and we knew, okay, great, we're going to let it, we know everybody in the summer of 2020 knew that the stock market was way ahead of the current fundamentals. But they're thinking, wait a minute, this will bounce quickly because once we get the vaccines. But the thing is, we didn't have those vaccines yet. Nobody really knew, but we say, okay, the market's up here, way above the fundamentals, okay? And then the economy started getting better. We got the vaccine early 2021 thing. But the problem is once we got out of the emergency mode, the Fed did not pull back on the emergency amount of stimulus. And so therefore, after it caught up for a while, it never came back to fairly valued. And all I have to do is look at those valuation levels that I just mentioned. If the stock market had stopped going up at the pre-pandemic levels, which is about 20% below current levels, then the economy would have been allowed, to play catch up and we'd be fine. And the fact that the Fed was cutting back on the stimulus wouldn't be as big a problem. I mean, back in 2013, when they pulled back on QE, and they did it again in 2015, people were like saying, well, it didn't hurt the market then. Why would it hurt it now? Well, that's the reason. The reason is because in 2013, the S&P was trading at less than 15 times earnings. It was a cheap market, if anything, certainly fairly valued, and if anything, cheap. All right. So therefore, the economy on its own could help the market. The market didn't go down. Now we have a situation where all this excess liquidity that was left on too long has pushed it way above it, so it has to come back down. We have to meet somewhere in the middle. Luckily, the economy is still in pretty good shape. And so it's even though it'll probably slow down a little bit, level off, that's fine. We'll meet somewhere in the middle rather than the stock market doing pancake, which usually happens because when the economy, when the market's fairly valued and the economy turns down, well, they both go down together. In this case, even though it'll level off a little bit, it'll just be the stock market coming in. And then I'm going to look at this thing with margin debt. This talks about the leverage in the system. And that's what's happened with all this excess liquidity. Investors, hedge funds, individuals, all institutions been willing to add debt. This is margin debt. This is basically the leverage in the system. Look how high it is. All right. And look, again, this is another lousy timing tool until it rolls over, and it's starting to roll over. Okay. Look what happened in 2000 when it rolled over. Look what happened in 2007 when it rolled over. Look what happened in 2018 when last time the Fed tightened. Again, it was only a 19% decline rather than 50% declines like these other two. But now we're starting to roll over again. And that's when leverage has to be unwound. It doesn't, you have to sell. I mean, it's like, well, I don't have to, I mean, if you're not leveraged, you don't have to sell anything. I love these stocks. If the market goes down 25%, I don't care. I'm just going to ride it out. And in 2 years, it'll be right back to where it was. And that's great.
Right.
But if you're a leveraged investor and your stocks go down 12, 14, 15%, then you start getting margin calls. And you have to sell, whether you like it or not. You have to sell or add more money. And one of the cardinal rules is never meet a margin call with cash. Just sell the stock. And this is what exacerbates the move and tends to hit the market a little bit hard. And that's why I think, even though the economy won't get hit hard, the stock market could and should get hit pretty hard. So
okay, right.
Sorry, Rodrigo, you want to say?
Yeah, no. I mean, you're doing. I mean, this is generally like your analysis, right, of what you're looking at in the markets right now.
Right now, yes.
Okay. All right. Yeah. Once we get going here, a couple folks here want to hear about a couple trades from the chat room. It looks like
Absolutely.
Some of the option trades and such.
Yeah, we'll definitely talk about that. Right. So just say one last thing to talk about, just with look at if you want to see what the influence of the marketplace. I'm sorry, the influence of liquidity and stimulus that the Fed provided. All you have to do is to look at the difference between the S&P and the ARK Innovation Fund. Now, I think Kathy Wood's a brilliant investor, but look what happened here. Look when the first couple of months, right? They both moved up together, okay? Because the economy was flat on its back, so everything went up. But then these highly leveraged companies with they're great stories, but they got momentum, and look at that outperformance. It just, obviously you can tell it was off. I mean, everybody was talking, that's all anybody could talk about was the ARK Innovation Fund. That's great. But then what happened when interest rates started going up? Okay, in February 2021, this past year, interest rates started going up. The Fed started talking about setting the table for QE programs. And look what, the stock market kept going up, and the innovation fund got clobbered because it was so dependent on that liquidity and so dependent on lower interest rates. And it shows, and again, I'll just show you here. This is February of last year. Look at that. See how interest rates spiked up? And that's what caused the ARK Innovation Fund to start getting hit. And that's really just what we're trying to do. And I guess my point is, this is going to create a lot of opportunities on the downside of the market. It's going to create some Here, let me pull it here. Bang. Some great opportunities on both sides of the market in the options market for the last year and a half or since March of 2020. It's been straight up, and everybody's been making calls. The problem is, I think a lot of those people are going to continue to try to buy the dips and buy calls on the dips, and they're going to get killed. Whereas what we're going to try to do is, we will do in both directions, because whenever a market falls, whether it rallies in a straight line, nothing rallies in a straight line, nothing falls in a straight line. And we see time and time again, whether it be the dot-com bubble, 2008, even in 2000, certainly 2018, huge bounces in the stock market, 10 to 15% that lasted in some cases a couple of weeks. And they're rather than using just fundamentals, you're losing positioning, using the stock, using technical analysis, et cetera. We can really turn things around and catch those things. Maybe not at the exact turning point, but at the turning point now. So what have we been doing this week? I mean, we had a couple of things this week. Equity.
This is in the chat room. This is like
in the chat room.
Okay.
We started talking about Tesla, and it was been a very interesting week, because we came in, they reported really good news, and the stock was up, stock was strong, and people saying, where is this stock going to go? Where is this stock going to go? And when it opened that day, and it opened up, whatever, it opened up at maybe $1,150, and it kind of sat there and went down. It looked like, is this thing's not going to hold? Well, sure enough, it bounced around all over the place. We came in, as somebody asked me, I said, this thing doesn't break down, can't break below. It's, I'm sorry, after it broke below its opening low, it bounced back nicely. And I said, this thing's going to 1,200. And sure enough, we ran that thing right here on that day. And we bought the call options in that, the $1,200 call options. And sure enough, it ran to 1,200. People make anywhere from 30, 50, in some cases more than 100% in just a few hours. And this thing, now I must admit, when the stock got to, I think it was 1194, 1195, I said, hey, let's take profits. I mean, people were up 50, 60, 70%. I don't want to get greedy, because you never know what can happen at the very end of the day. And so we walked away from that thing, and it worked out really, really well. I'll just take another one that happened last night. Or I should say last night, we had a call on the QQQ, and let's just lighten this up here. The QQQ, we came in this morning thinking, I'm going to do it a different way. VIP. Oops, GP. There we go. Okay, it came in this morning, and I was neutral. It's like, let's just see how this thing breaks. It sold off. We'd already made some money in the puts earlier in the week. I made that negative call. I'll go back to that too as well. But anyway, this morning we came in, and I was like real worried here. I said, no, let's just sit on our hands. Then it broke down here. And then shortly after it got down to this level, I said, let's look at the calls. Okay, let's buy the calls. And people came in, and we ran it all the way up. Now, one thing is that I did think it would go higher. It kind of bounced around. Of course, at the end of the day, it fell down. But a lot of people got out of their puts anywhere in here. They traded sideways. They still made a lot of money, because we were buying the 383 calls. I'm sorry, the 383 calls. So they're still in the money. In fact, they closed in the money. I still own a few of them. Now, what we're going to do tomorrow, and what we did very late in the day, is we also bought the S&P, the SPY calls, just slightly out of the money, and the QQQ calls. I still have a few puts, a very small amount of puts as a hedge, and that's what you can do. Tomorrow we have the big employment number. Today there was nothing that would tell me, oh my gosh, we're going to see a big move in the market, and we didn't. We got a little bit of some volatility at the very beginning of the day. Then it just did nothing all the rest of the day. Why? Because people are waiting for this employment number that comes out tomorrow morning before the opening. So my thing was that we want to set up, even though I'm bearish and I think the market is going to see a full-blown correction over in the next few weeks. It's really starting now, I think, and it will last for several weeks, I think. Is that we want to buy some calls. Why did I make that call? Well, here is the yield on the 10-year note. Okay, this is what everybody's looking at. If the employment number comes in stronger than expected, okay, people are going to say, oh my gosh, everybody's worried about inflation. The yields are going to skyrocket higher. and the stock market's going to get pummeled again. Well, even though I'm bearish now, I think the bond market will get hurt again. Look at what's going on. First of all, see that? That's what's called the RSI chart. It's overbought. Look what happened the last time here. Okay, it wasn't a big sell-off, but it was lasted several weeks. Look at this one here when it got there. Went down for 4 days. Look here, okay, 2 or 3 days. Okay, and here, now there's no question it got more overbought, but each time this year in the last 4 months, it got to this level, the RSI, which is the relative strength index. And when it gets up to 70, that red line says stop. Okay, it's not going higher. Investors stop. When it gets down, it gets oversold. That's why it's a green line down at 30. Buy, green, go ahead, buy. Green light, red light, right? So this is getting overbought. However, also, look at this huge move in rates just in the last 4 days. Huge move. Nothing goes in a straight line. This long-term yield may go to 3% by the spring, which that's not going to happen. But even if it was going to happen, it can't go in a straight line. And look at this rally here. It was a fairly significant rally, but it pulled back here, it pulled back there. Same thing here. This big rise in rates, pulled back here, pulled back there, because it got overbought on a very short-term basis. I think this thing's going to pull back, right? And right there, it's testing, and especially if we do it on a closing basis, it's very close to testing its March highs, but it's very overbought. Experience tells me that when something is very overbought and about to, testing a resistance level, it usually takes a little bit of a breather to digest its recent gains. Then it makes another run higher. Same thing on the downside. If the stock is oversold and tests a key support level, it usually digests those losses, usually kind of back and fills a little bit, bounces around a little bit, and then breaks down because a few buyers come in thinking, this it's going to make another bottom here, and then it falls out of bed. Same thing here. People are like, wait a minute, this was a major, really important high for interest rates. How much has really changed in the last week? Has it really changed that much when it was below 1.5%? Now we're going to break to new 12-month highs. My point is that the S&P, the bond market, the treasury market, okay, there's a very good chance, in my opinion, that even if we get a strong number, we'll get a sell the news reaction. Now, when I say sell the news, it would really be buy the news, because in the treasury market, of course, when bonds go down, yields go up, and in this case, they'll buy the bonds, so the prices will go up, but the yield will go down. And the reason, again, because it is overbought. And on a short-term basis, there are too many people on one side of the boat. Too many people are looking for higher rates. Too many people are looking for a really strong number tomorrow that they're all set up for it. There's nobody left to push it higher. So they're going to say, oh gosh, there's a weekend coming up. I need to get out in case something big happens over the weekend. And this is going to sell off. That's going to be bullish for the technology stocks. It's going to be bullish I think for Microsoft. And I'll show that in a second. But these are the types of things we did. We were looking at the Microsoft calls at the end of the day. And so we bought those, the 315 calls. And so again, we'll see what happens in the morning. At 8:30, the market's going to be all over the place. If it's going to have to be such an incredibly strong number to push yields any higher, because if it's lower than expected, yields are going to fall out of bed and the market's going to take off, a stock market. If it's in line, like I said, it's already priced in. So yields, I think, will fall and the stock market will rally. Even if it's a little bit higher than expected, because I think yields will fall and the market rally. Only if it gets a huge strong number and yields take off, then the market will come down. And that's why I have a small amount of puts. So what I have is that we have some call options in the QQQ, Microsoft, SPY in these areas. And we have a small amount of puts just in case if the market, I think the chances that the market does nothing tomorrow are very low. It's been very volatile lately. There'll be a big move. And so if the market does fall, at least my put options, the small number, will cover my costs. I'll come out flat. Okay, I won't lose any money. I won't make any money too bad. I mean, obviously, if some people are going to be betting on a down market, and they'll make money. I won't. But if the market goes up, stock market goes up, I will make way more money than I lose in that small number of puts. But that's what you can do when you're hedging in the options market. If you buy a stock, I go, oh great, I buy Microsoft and I short Apple. Well, they both go up the same. You don't make any money. I mean, but the options, they just move so much more. So okay, I lose a little bit of money here, and the options, and the other side of the trade goes way up here. I make way more than I lost on the other side of the trade, on the other side of the hedge. So
Hey, Matt, really quick. There's a couple of people asking about the chat room here, the trading room that you have here. So I'm just going to post a link really quick in the chat. But basically, it's Matt's trading chat room where he's giving out picks. He's also answering any questions that you guys might have about your own trades, strategies, market events. Like if there's a CPI number or PPI number and it's important, like the jolts tomorrow. I think that's what you're talking about,
That's
Matt.
the non-farm payroll. The jolts were out earlier this week, but it's non-farm payroll number from the unemployment report or the employment report from the Bureau of Labor Statistics.
Okay.
Anyway,
And
but it's very similar. So.
And some people don't even like, I mean, I understand that if there's a new trader, they might not even know what that means, but it's very important to know that if you do want to be successful in a long term, to know what's happening around you. Otherwise, you're just, you're kind of guessing because you don't know what could happen. Like, trading on a day that you don't know there's Fed minutes or, that Powell's going to speak. It's kind of rookie mistake, but that's why in the chat room, everybody helps each other out. Right. And you're on top of that. You help them out. And you also, point out, this is where you can profit from this event, right? Instead of just figuring out, hey, what happened, that kind of stuff.
That's exactly what, and we've done that. We did that when the Fed meeting, and I'll go over that in literally in 30 seconds. But just to say, we did it. That's what I did today. People are asking, what do you think about? And I went about the Fed, the employment number tomorrow, and what impact will that have? And that was the thing. I went into, say, deep detail, but I went into the details about how what I just talked about, how a lot of it's already priced in a strong number. And why do I care if it's a strong number? Well, if the employment number is really strong, especially if the average hourly earnings, in other words, the wage numbers are strong, that's going to scare people about inflation. Wage inflation, that ticks over to all-purpose inflation, and then people start worrying about stagflation and such, and that causes interest rates to go up. And when interest rates go up, stocks go down. So that's why this is such an important, it could be, it's not always a big market mover, but it frequently is. And this one's one because the Fed has made this big change in policy from massive accommodation to tightening, that this number, I mean, the employment number is probably the most important economic data point that any market follower looks at, whether it be bond market follower, stock market follower, whatever. So that's what we do. But it's interesting, because one of the things, just to go back to what happened in December, we had, the Fed was coming on to a meeting. It was December 15th. And, the QQQs are very volatile because they're the most, they have the most sensitivity to move in interest rates. And they had sold off in the going into the Fed meeting. People were worried that Fed Chairman Powell was going to be, ultra hawkish. And he actually was. But again, everybody was set up for it. Everybody knew it was, everybody thought it was coming. And so they all said, okay, the market's down, but I think it's going down a lot more. So a half an hour before the Fed announcement at 2 o'clock on December 15th, I came in and said, we're going to buy calls here. We're going to buy calls because it's already built in. Okay. And sure enough, we made 360% in the next morning. Okay. The next morning, we sold them right at the opening for over 300% gain. Okay, because I saw this big opening. I'm like, I have no idea how long this is going to last. You're up 300%. When are you going to get greedy? You're up 300%. At least sell half. I mean, that's
what about the puts? Because I know that you traded it on the downside after.
Exactly. And then right there after, I said he was really bearish. I mean, and that's why he was really hawkish. He has changed. This is surprising people. And again, talking to my institutional customers, they're like going, they were telling me left and right, he's going to calm the market down. He doesn't care. And I'm like going, no, this is like 2018. His tone has changed. He is definitely going to be more hawkish. And sure enough, I went back down and we made 150% on literally in the same day. Today, I mean, today we kind of did the same thing too. I mentioned those QQQs that we bought the calls. Well, the QQQ puts that we had going into the day, there wasn't a lot of them. We cut back on those. We sold those with a nice profit and bought back the QQQs on the way up. Microsoft also had a nice gain. It didn't hold as much. A lot of times, one of the things that with this volatility, I myself too, and we're all kind of learning this, is that we need to take profits a little bit more quickly. When you have the profit, take it and move on. Sometimes, especially when it happens near the opening, because we get opening gaps that fail all the time. And it's the biggest thing is that you don't want to do when you're trading is when you, especially if you have a sizable gain. You've got a sizable gain and it keeps going and you sell it too early. So what? Just pat yourself on the back and move on. You are never going to get the actual maximum gain on that. If you do, you're lucky. I don't care if you're Paul Tudor Jones. He'll tell you, be the first one to tell you if he got the exact low when he got in and the exact high when he got out. It was pure luck, and he's one of the best. So that's what these things that we try to do, especially when there's key moments coming up. Last month, it was a key moment around the Fed meeting and press conference. This time it's we just had this big Fed minutes that usually something people don't pay attention to, but that's what happened yesterday. We came in and the Fed minutes, we were buying the puts, SPY and QQQ puts. And I said, and when the market started getting hit, I said, we got to get out. We got to buy, we got puts. This market's going down. And, the market looked really strong in the morning. And let's just put this up here.
Yeah, I remember that you predicted the last two corrections here in Benzinga while we were doing a presentation. But, more importantly, Matt, there's a lot of people that are new in the market and they're probably, trading like the same EV stocks from last year. And, things change in the market. And I know that, with the community that you have in the chat room there, everybody's, like helping each other out. Because otherwise, if you're going to these pump and dump chat rooms, like these Reddit boards, some people are just fooled, and they keep buying stocks like that, are just not coming back pretty much. So
exactly.
Great value.
That's what they do. They push up a stock and they buy a bunch of it. Then they go out and push it. They buy a big position. Then they use a little bit more capital to push it even higher. And then when it starts to run, and then they start dumping it, called pump and dump. And they did it in the meme stocks this year. I mean, one of the best ones, most money, those of you who've heard me before are probably tired of me talking about this, but it's a great call is that a great call I made, not a call option, call I made was on Viacom. It was one of those meme stocks, and the stock got ridiculously overbought. And I mean, it's like, wait a minute here. I mean, this is not one of those great opportunities that ARC opportunity plays that that fund was trying to buy. This is Viacom, and it's a media company. Okay, well, there's nothing wrong. I mean, it's a great company, and in fact, we're getting into it now in the chat room as a stock. I did hold off. It worked out well because I did say let's not get too involved in the calls yet because it's over. It's really had a big run here on a near-term basis. But look how overbought. Remember, I talked about the RSI chart. This is the weekly RSI, weekly relative strength index. Look how ridiculously overbought this stock was in March of last year. And I came out and said, this is on the tier 3. We got to go in and we got to buy the calls. I'm sorry, we got to buy the put options. In one day, we made 2,500%. And other people holding on made over 5,000%. And one person even said, and certainly theoretically, they could have made over 10 to almost 12,000%. And this was just, like I said, I wish we could have one of those a month, one of those a week, even one of those a year. But hopefully we will get another opportunity this year. But these ones only come around once in a blue moon. But there's a lot of other opportunities that come up all the time. And I think what we're having here, I mentioned, remember I talked about how I think the stock market, I'm sorry, the bond market is ready for a bit of a turnaround. And this is what I try to do. I try to help people looking at things just like Microsoft. My concern, it's a great company, great company. It's got great prospects, okay? And if you're a long-term holder, like I said earlier, hold on to the stock. However, it's got very overbought. It's expensive, and its price earnings ratio is at multi-year highs. Now, again, it's just because something is expensive doesn't mean it will roll over immediately. However, you see how the stock is flattened out in it's just 2 months. Everybody's talking about how it's sold off in the last couple of weeks, but it's really done nothing for 2 months. And more importantly, the CEO, who is an unbelievably great CEO, done a great job with the company. He sold 2/3, $374 million of the stock. It made a lot of news when he sold half his stake, but he sold more, almost 100 million more after that. He sold it right here, right before Thanksgiving, but he sold more in here. I'm sorry, but these guys, insiders don't sell that kind of size unless they really feel the stock's not coming back. And we can talk all about the tax. If you've heard me say this before, I'm sorry, but I'm so adamant about this. It's such a great learning lessons when insiders buy. Back in 2016, Jamie Dimon bought $25 million worth of JP Morgan stock. Okay. That was, I wish I'd put every penny I had in the world into that stock, because the smartest guy on Wall Street was putting that much money into his own stock. That tells you all, it's all you need to know. Now, again, sometimes they, sure, people sell, a couple million there, a couple million that, whatever, fine. But when you sell 2/3 of your pay for a guy who's still relatively young, and he's not retiring anytime soon, all right, he's telling you that it's too extended, and he believes, I'm just guessing here, but that he knows what's happening with the Fed, and the market's going to have a tough year next year. Forget about those tax things. You say, well, Washington State's got a tax law of 7%. Okay, yeah, okay, I can understand usually that some people would want to sell. If you live in Washington State this year, I can understand that. But if you own Microsoft, and you own a lot of it, and you know what's going on, and you sit there and go, this is a really good company, but it's way ahead of itself. He knows it is. But it's like, if I think it's going to keep going higher, why would I sell it if I'm just going to lose 7% in taxes? It's averaged 33% over the last 9 years. Averaged, okay? 33% gain. The worst year was a 12% gain. So that would more than make up for any kind of 7% increase in his capital gains tax. So if he thought if it was in here and he was really bullish, he wouldn't care about the 7%. But he knows that the stock is expensive. He knows that the market there's going to be some deleveraging in the marketplace this year, and he sold. He's a smart. He is not doing anything illegal, unethical, anything. The guys who do the unethical stuff are the guys who know that they're about to get a scandal, accounting scandal or some sort of sexual harassment scandal or something. He sells the stock. That's insider. That's bad information. He's selling just because he's like, I think the stock's getting out of hand. And it goes back to, I'm sorry if I'm boring some of the people done this a while, but it's such a great example. When big people sell a lot of their stock, it is always a key sign. And I said 1999, Goldman Sachs sold their stock through an IPO. Now they say they didn't go completely public, but they sold a big chunk of their shares and still held on to some, right? Each one of the partners. What did they do? Why would they sell? They're a private company for 100 years. Why did they sell? Well, they saw what was going on in 1999, and they knew it couldn't last. They sold the stock, so they went public. The next year, the market crashed. In 2007, Blackstone, not BlackRock, but Blackstone, the biggest venture private equity firms, biggest and brightest people on Wall Street, and they went public in summer of 2007. What happened a couple months later? The market topped out. We had the financial crisis. They saw it coming. Okay, Glencore, one of the 2 or 3 biggest commodities traders in the world, they went public, and again, they didn't sell all their shares, but they sold a bunch of their shares in spring of 2011. 2 months later, in May, the commodities market began a 8-year bear market. They saw it coming. They saw that it was too far ahead of the commodities were way too far ahead of themselves because China had bought all these things, and they knew they weren't good. They saw that China was going to start pulling in their horns a little bit, and they sold. And Sam Zell did the same thing with his real estate company. It wasn't an IPO, but he sold his company in 2005 or 6, right before the top. Smart people see what's going on, and it's their life. It's their life. Why would I sell my company? Because it's not coming back. It's not coming back anytime soon. I can cash out now. I can still go. And again, these guys still ran their businesses. Goldman still ran their business. Blackstone still ran their business, et cetera. They just cashed out and still held on to a decent amount of shares. And before I move on that, is just to remember that just because a company goes public does not mean that the stock is going, that the stock is the company's going to have trouble or the stock's going to have trouble. Although in the last year it certainly has. But a lot of times it's a company that's just been around for a few years, and they decide they need to expand, and then the only way to do that is they can take loans, but say, hey, let's sell some stocks so we can raise some money and build new factories or whatever they want to do, expand into other parts of the world. So it's not always the case. And also, as I said many times in the past, Microsoft went public and the stock kept going up, and it's like, so that's that's a bad example. And it doesn't work. It doesn't counter my theory, because Bill Gates didn't sell any stock. He sold 1 million shares. That was it. And he held on to. He said publicly, "I would rather be buying." I just needed a few money to walking around money. He needed. I always joke he's still living in his parents' garage. But then the point was that he did not sell. And so be careful on that IPO. Just because a company goes to the IPO doesn't mean that business is about to go out of business. And not at all. But when companies, especially companies that have been around a long time, suddenly decide to go sell a big chunk of their, and the insiders are selling, That's a problem. And that's what Microsoft is doing. Now, I'm sorry to ramble that, but look what's going on here now. The stock is it's 100-day moving average, right? This is that dark green line. It's getting oversold, not as oversold as it was here, but it's getting oversold and more oversold than it was before. It bounced here and here, right? This is its relative strength index stock. Now, it got down, actually got a little below that line, but that's only that doesn't tell me only whenever something breaks slightly below a support level, it frequently tells us that it's usually just a head fake. In fact, if you go back here, you can see, ever since we got the last correction in the stock market, which was September of last year when interest rates moved up, we saw how it actually got below the 100-day moving average several times, but each time it still bounced. So each time was a head fake. More recently, since this year, it's been, so here we are right here. If I'm right about the bond market, if I'm right about what the reaction to the employment number and yields go down, this stock, which is getting oversold, should bounce nicely tomorrow. And that's why I went in and suggested buying call options. And these are short term, they expire tomorrow. We refer to those as lottery tickets. We don't spend a lot on those because they're obviously high risk. You don't want to invest, bet the farm on something on an option, looking for a big move the next day, and you only have one day for it to happen. But in this case, the odds, the odds are better. I'm just guessing. Where we have an issue where a stock is oversold, the bond market is oversold on price, overbought on its yield. And so we are going to get a catalyst tomorrow for a big move. And so that's why, again, combining what I've seen in sentiment and positioning with the CEO selling a big amount of the stock, look what's happened to the stock since he sold, plus technical analysis, I think this stock is going to go lower, to be honest with you. I think it'll probably test this 200-day moving average, even though it's a great company, even though it's going higher. Like I said, Amazon, Apple, all these companies have had huge Bitcoin, huge sell-offs on their way to much higher, on the way to changing the world. And we want to be able to take advantage of those. So we bought some Microsoft, some guys bought some Microsoft puts. Now we loaded up with the calls today. It looked real good for a while. And it came out then not so good, but it was fine. I mean, we didn't lose our shirts. But tomorrow, I think this is going to be a real good play. Now, I'll just talk about another one that we're talking about right now, going back to this situation with interest rates. Now, here we are with Bank America. Bank America, now, I know Brian Moynihan. I don't pretend to be his best friend or anything, but I do know him. And he, so I am a little biased, but he's done an unbelievable job running this company, unbelievable. And I remember not long after he started, they were wondering if it was a big mistake, and it turned out to be one of the best moves any company, much matters, has ever made. And he's done an unbelievable job. But the stock, again, it has sell off there, it has sell off there. It's had this great rally, but it has sell-offs, okay? I worry that see how the stock saw a big shoot up when interest rates moved up, but it hasn't been able to break out here. It has tried each of the last 3 days. And again, my experience as a trader tells me, see, it's going up against this tough resistance level. It's tough to make that higher high at a time that it's overbought. Okay, you see that line, that RSI down here. Now it's not as overbought as it was here, but it's still overbought. So it's having a tough time breaking above that level. So if it can finally break above that level, it's going to take off. It is going to take off. And so therefore, if I'm wrong about the bond market and the number does shoot, tomorrow's employment number does shoot interest rates higher in a big way, this stock's going to take off. If, however, it does what I think it will do and cause the interest rates to fall, and bank stocks are very highly correlated to interest rates, and we can go over that. But this stock is probably going to pull back. That's okay. That's okay. I mean, it pulled back here, made a higher high. Pulled back here, made a higher high. So I'm not worried about it longer term. But this is what we do for a one-day trade. We went in today, late in the day, and we bought what's called a straddle. Now, my work here, I'm a stock trader and a strategist. I do not get into really complicated option strategies. That's really not my audience right now. And for those who are very sophisticated options traders, when they're in this chat room with me, that's not what they're looking for. They're looking for places, entry and exit points, and that's what I do. But in this case, we did do what's called a straddle, and what that is when you buy a put and a call with the same expiration date and the same strike price. So what I'm saying here is that This thing is wound. It's wound like a coil. Okay. If it breaks above it, it's going to shoot higher, and we're going to make a lot of money on the calls. If the interest rates fall hard, the stock's going to fall hard on a near-term basis. I'm just talking about tomorrow. It's going to move. I could be wrong, and the stock could go sideways, and nothing happens, and we'll lose money on both options. That'll be too bad. We'll know that early in the day. But again, it's a lottery ticket. We're not spending a lot of money on it because it only has one day to go. But my point is that there are, every week we'd love to have those things but not every week do we have a Friday where the market moves in a big way. Tomorrow, the potential is really high that it moves one way or the other because Bank of America is overbought. It's not extremely overbought, so it could still go higher. Okay, the bond market is extended, and if they reverse, we'll make way more money no matter what. The odds are very high, in my opinion, that Bank of America is going to see a big move in one way or the other. Okay, so whatever we lose, so if it takes off, we'll make more money in the calls, way more money than we spent on the puts, and vice versa if the stock goes down. So these are the types of things that we're talking about all day long in the chat room to try to take advantage of these dislocations in the marketplace.
Yeah, for those asking, yes, Matt will be following up with this trade and every other possible trade that we are going over right now. What are your thoughts on Tesla, Matt? I know you're in and out of that, so
yeah,
where are we with that?
We've had some good, like I mentioned this week, it worked really well for us. Earlier last month, in the late fall, early winter, I turned negative on the stock. I kind of ticked off some people in the chat room, but again, it had nothing to do with me saying there's a problem with Tesla, but they didn't think I was like calling for it to drop below 1,000. They thought I was completely nuts, and I'm like, I just didn't understand how when a stock has dropped 20, 40, 60% many times, why it couldn't do it again. And again, I didn't have to look for the end of the world in this stock to say that the stock, but again, I looked at positioning, I looked at, let's see, the stock dropped 30% on an intraday basis. Does anybody who owns it long-term sell the stock here? No, of course not. But you can still take advantage of it. So what do I think now? To answer your question, let's just kind of clean this up so we don't have so many darn lines that you're looking at. I do worry near term. And I say near term, I mean over the next couple of weeks, not just the next couple of days. I do worry near term that this is part of that whole, again, it's gotten further ahead of itself more quickly than it should have if it hadn't been for the Fed's largesse, if it hadn't been for the Fed's liquidity and massive emergency levels of liquidity. Now, I'm not saying the only reason why this stock has rallied is because of liquidity. Absolutely not saying that. Here's another situation where the CEO sold a lot of stock, $20 billion worth of stock. Now he says he's done. Well, he says he's done with what he has to sell because he has to sell that by August because the options expire. But he could have waited. Now maybe he thinks the national capital gains tax is going to rise, but looking at Biden, I don't think that's going to. Again, I'm not making any political statements. I just know he doesn't have much of much support for that. So I don't think that's going to happen. And so why did he sell them now rather than wait until some other point in the year? I think because he feels that with the Fed pulling back their liquidity in a major way, it's going to be the stock will probably come down a little bit. That's okay. What he's doing is there's nothing wrong with what he's doing. I'm not questioning his integrity any way, shape, or form. He's brilliant. He's done an unbelievable job. This stock should go a lot higher. But my point is, so that I'm a little bit worried about that. And we've seen this little pullback here. Tomorrow, again, we're looking at that 50-day moving average. You can see it hasn't been the biggest deal in the world. But right now, what I'm really hoping is that it comes back down to the 1,000 level. And even this could qualify this move here. But either way, if it starts going back up, look at this. And again, it's hard for me to draw it. Let me get rid of some of these lines here. Some more of these lines. Let me get rid of all of them. But what it's starting to form, an inverse head and shoulders pattern. Okay, here's the left shoulder. Here's the head. Here's the right shoulder. Doesn't matter. It would be better if it was perfect, went right down to 1,000 like it did here. Okay, but this is your neckline. The neckline isn't straight. The necklines are frequently at a diagonal, one way or the other, up or down. This thing breaks below. Okay, let's look at the stock on a. This is going to be only closing basis, no intraday stuff. Oops, what happened? equity. Sorry. Let's look at it on a closing basis. Same thing. Now this is a little bit less because we didn't get the armpits didn't get up enough. But either way, you can see you get above 1200. That's key resistance. Okay, it did get a little above it there. Let me go again here. But you can see that you got an inverse head and shoulders pattern. And I'm sure you've heard a lot about, as you can see that this armpit did hit there. This armpit did hit 1200. So if it breaks above it, this stock is going to skyrocket. And it'll be better once it gets above this, it's a new all-time high. But this is one where I think near term, I think the stock's going to do better over the next few days because I think interest rates are going to come back down. But I'm going to be a little careful here because when it gets up here, so in other words, if you want to buy the stock or play in the options on the calls on the buy side, that should be a good idea over the next few days. After that, I'm not so sure. I think it'll take a little bit of time of fiddling around here before it takes another run at that level. And so in other words, I want to be a little bit careful on it. Short term, I like it. Intermediate term, I'm a little careful. Longer term, I love it. But that again, if you want, I guess my point is, you get above 1200. You want to start nibbling. You get above this high, which was 12, closing about basically 1250. You want to back up the truck because this thing's going to go. Now, what happens if I'm wrong? And this is on a longer term basis. If this market if the whole market gets hit hard, which I think is a good chance, this stock, maybe not necessarily now, but at some point in the first half, could come all the way down and test its 200-day moving average. And people are like, what, are you crazy? I'm telling you, if you get forced selling, like I mentioned, that's what happens when the stock market, when leverage has to be unwound. And that presents unbelievable opportunities. And so just keep this in the back of your mind. Always be looking at that 200-day moving average. I'm going to move it here. Again, I'm looking totally at the technicals because I do believe the stock is ahead of its fundamentals. And that's another reason why I think the stock will come down. And that's okay. It's going to provide an unbelievable opportunity. If you already own it, especially if you own it at much lower levels, don't worry about it. Just sit in a long-term portfolio. Just let it sit there. Okay. But on your trading, you want to be able to trade around it. But look how important that 200-day moving average has been. Right there, way back in the March, when during the pandemic, it couldn't break below its 200-day moving average. Unbelievable. Here it broke through, but only very slightly. So that was a head fake each time. So yeah, again, so it may get down to 800, and even, well, by then it'll be up above 800. So maybe it breaks slightly below it. But that's when you start backing up the truck and buying the stock. Because right now we have a situation where many, even if people who don't own Tesla on leverage in a big way, and I think some too, they own a lot of other stocks and maybe other assets like Bitcoin or other cryptocurrencies on leverage. So when they go in, especially in some of these lesser liquid names, they get a margin call. They've got to sell, and they go, "I need to sell my stock." And well, no bids. You'll have to sell it down another 20% to raise the money you need. Well, that doesn't work. I mean, all you're doing then you just get another margin call. You just owe more money. So what do? You go and sell what you can sell. There was a thing called long-term capital management in the late 1990s that had huge positions in very illiquid bond assets, and they couldn't sell them. They had margin calls. They couldn't sell them. So they sold what they did own in size, and the one thing that was very liquid, which at the time was one of the best companies in the world, General Electric. And they just kept selling it because they had to meet their margin call. It didn't matter what they thought of the stock. They liked the stock. They loved the company. Jack Welch was in his prime of his career. They sold the hell out of it. Was it 1997 or was it 98? And it created an unbelievable opportunity for investors to come by because people had margin calls and they had to sell what they could sell. Tesla could easily be one of those stocks. So could a Microsoft. So could an Apple. And it's going to create unbelievable opportunities. And that's why we're working here on these. We do some little trade. We do little trades here and there on a to make some nice profits on a daily or weekly basis. But we're also looking for these key turning points where you can really back up the truck. Like, I made the call on the bank stocks several times this year. Energy stocks, we could talk about that if you want. Something I'm just going to show you one thing that I did here. And what I really try to do with also, and I need to do more of this, but there hasn't been key turning points as much lately. So here it is. So
yeah, take it away, Matt.
Yeah, talking about it. But here are the energy stocks. I told you about how I really, really loved the energy stocks, 15 months ago, way before everybody else did. This is where I said buy. You see the thing? I went buy all those fundamental positioning. I was a little early. It did come down, but I still, don't worry. It was holding in there. Then it started to rally. And it got up here. And one of the things here, remember, I used all that stuff where I talked about overhated, over shorted, and very cheap. And then, of course, it was very oversold because RSI was very oversold. Then it got up to here, and people like saying, ooh, should we sell? And I was like, no. This has still got plenty to go on an intermediate term basis. It came down to here, and people really started getting nervous. Like, oh, that was it. It was just a short-term, short covering rally. It's not going to last. And I said, no. Went back to my fundamental analysis, looked at everything still looked good. I looked at my chart, and it had a golden cross. The golden cross is when a 50-day, the rising 50-day moving average rises above the rising 200-day moving average. And we can't see it here, but in the past, that has been very, very bullish. And sure enough, look how much it rallied. Then it finally became overbought. So I said, okay, let's cut our position in the XLE in half and even look at some put options. Okay, short-term put options go out a week or two. And then, so we cut it in half and we came down here. Then I went back to a full position here, and it really wasn't oversold. But again, I was looking at the sentiment readings, and I love the long-term story. I really thought it was the early innings, and that worked out really well. Again, we came up here, the XLE got overbought, took some profits, bought some puts, and it did the same thing here now. And again, went back into a full position here. I didn't catch the exact bottom. I got really worried here when it broke the 200-day moving average. I was like, uh-oh, we may have some problems. But of course, it took off. And this is a chart from a presentation from a while ago, so it's not up to date. But you can see, we all know how well they've done since then. But the point is, that's what we're trying to do. And it's funny because this week I've done it in Microsoft where I'm saying let's buy calls. And I'm sorry, earlier in the week, the QQQ, AMD, somebody asked me about AMD, Advanced Micro Devices, Microsoft, buy puts. Now I'm going to turn around because they're oversold on a short-term basis, and we have a catalyst tomorrow which might take it a lot higher. So that's what we're really looking for. And, we can play those things. Now, those are really short-term ones, but as you can see, on multi-week basis, you can really make some nice moves trading around your position. Now, if you like the energy stocks and you have the XLE ETF or the XOP ETF, which is oil and gas stocks, energy and exploration, you'll say, okay, let's take 80% of it. We're just going to sit there and let it sit there for 2 or 3 years. But I'm going to take the other 20% of it and trade around it. And with the ETFs, you can do that. And sometimes you can play in the options too, where you can, again, scalp. Again, people who sit there and go, I'm going to time my entire position in XLE and sell it all here. I love it long term. I'm going to sell all of it here and hope that that's great. That's a losing proposition. But because the thing is, if you sell, in these cases, I said take half. Usually it's more like let's take 20% off the table and play with it a little bit. And the reason why is that if I'm wrong and the stock breaks to a new high, I can say, let's get right back in. So if a thing goes up 100% a year, like a lot of these stocks have, and in the middle of it, I said, let's take 20% profit and play with it. And then the stock goes up another 5% before I get back in. Okay, the stock was up 100%. I missed 5%, so I'm only up 95%. But actually, I only missed 5% on 20% of my position. So I didn't miss much, is my point. And that's why, again, I use technical analysis to help us when we see that some of these key turning points are wrong, because it's not a science, it's an art. But it can work really well and work in our favor. And that's what we're constantly trying to work on when, in the chat room. Again, some of these short-term ideas are great. But I do think that, when these multi-week plays work very, very well. And again, it helps you maximize your returns in what I will think will be an unbelievable year, unbelievably volatile year. If we were 2017, that didn't work so well. It wasn't much volatility. The stock market just slowly marched higher. All you had to do was buy an index fund and go play golf or whatever you want to do, go to the beach, or go skiing, whatever. This with the volatile with it, and it gets, well, how do you know it's going to be volatile? Just because, it was volatile for a part of last year, especially at the end of the year? Yes, because there's been a big change in Fed policy, and they're not the only ones in the world. I mean, we've seen, we also have the second, so that's the biggest economy in the world, they're not just going from neutral stance to tightening, they're going from massive record amounts of stimulus to tightening, okay? And they're going quicker than we thought. So that's going to cause some headwinds, cause some problems. But we also have the second biggest economy in the world, China. Okay, they went from more than a decade of really encouraging debt, risk-taking, and leverage to now, in the last year, they've clamped down on all three. And they continue to clamp down on all three. In fact, one of their interior ministers saying, we're just starting to implement our anti-monopolistic policy. So this, I mean, we see it every day. And then, of course, you have Evergrande. There was another one today. Evergrande, who, they're basically insolvent for all practical purposes. But we also have issues where they're, there's another one who defaulted basically on one of their they're not going to make one of their coupon payments today. So basically it was today. So there are issues out there that are going to create some headwinds. That's okay. The point is we want to embrace it. Okay, don't be afraid of it. We don't want to just weather the storm. We want to profit from the storm. And like I said, in the old days, it couldn't do that. There just wasn't the ability for the individual investor to do that. Now there are, and I just think it's going to create some unbelievable opportunities this year because of these changes. And like I said, capitalism failure. Now, failure isn't good on a broad basis. It's not good for capitalism. Of course, we know that. And some people are too big to fail. Great. But failure in small businesses, that's part of capitalism. It's an important part of capitalism. Now, I don't want to be, it's actually an important part for big companies too. I don't mean to pick on the small business person at all. But what we have though, is that corrections, they wash out the fraud. If the worst thing the Fed could do, the Fed was too late getting started with this, but the worst thing the Fed could do was keep the pedal to the metal. And people are saying, there's no way the economy will slow down. There's no way they'll let that happen. I'm like, actually, they do. And they do want that to happen. They've said many times, just like they said in 2018, when they were tightening, there was too much froth on the market and they wanted to wring some of it out. Every single time, there's some people on TV I see that say tightening isn't necessarily bearish. I'm like, what planet they come from? Now, there have been a couple of times where it was a big lag between when they started tightening on the market. Only once where it was a big lag, but once back in 2006, 2005, or 2006, whatever, in that time frame before the real big collapse came. But in those times, the markets had not reached really overvalued levels yet. This time it has. So the odds that this will have a negative impact more quickly is high, and especially since a third of the time when the Fed tightens, at least over the last 50 years, it has caused the stock market to go down, and usually down significantly, but not always 50%. I mean, a lot of people here that the only bear markets they've seen was 2000, 2010, and then during the pandemic. It's like, oh my God, it was is that where? Well, most bear markets or recessions are mild. The market was down 20 to 30%. I don't know that we'll necessarily get a bear market, but I do think we'll get a deep one. And I do think the Fed knows this is going to happen. They want to make it gradual. There's still a safety net. They still have a safety net. Okay, but they don't have it. It's not as it is in the money, as I say. The Fed put isn't in the money the way it used to be. It's now more out of the money than it used to be. Oops, let me see if I can get this. There we go. There we go. Oops. Good afternoon, hope as well. Somebody. I have no idea who that person is. Anyway, so we talk about with the Fed. So we want to really move on. I'm sorry, I lost my train of thought there for a second. But what we're trying to do is just to focus on what the Fed is doing, what China is doing. Oh yeah, the Fed. Look at this here. I mean, there's a guy saying there's no way the Fed will ever let this the stock market go below 200. Look what they've been doing over the last 12 years. They will never let the stock market drop below the 200-day moving average. I'm like, well, the last time last time they tightened, that's exactly what happened in 2018. Oops, let's pull it back. Yeah. Okay. Just clean it up here for you so there's not so many darn lines that make it so busy. But hey, well, of course, we know it went below that because of the pandemic, but it went well below that. Doesn't look like much of a move, but and it's actually quite a big move below. And to think that they're never going to let it go below, they let it go below. And the other thing, the big mistake I strongly believe that people are making, I can't even, that's not 2%. This big mistake people are thinking is that they think that the Fed turned the tail and ran and changed their policy in 2018 because the stock market was down. That's not the case at all. Okay. It was the bond market that went down. Okay. See, it went 7% below that, almost 8% below. What does that take it this time? If it's only that much, I mean, that takes that's the wrong stock, but yeah, SPX. But anyway, it just, that's good because I want to get back to this 2001, 6. There we go. Okay, that's much better. I had the wrong stock. I had the stock SPX up. But look at this. Look how far it went down below its 200-day moving average, way below. All right. This is what the Fed did. Okay. In late 2000, fourth quarter, and people say, yeah, but they changed when the market went down. No, they didn't. Okay. Look they broke below the 200-day moving average in October. Okay. Failed to get back above it and fall down. In December 15th of 2018, when the S&P was way below its 200-day moving average, and it was down 12% from its highs. Okay. 12%, not 3%, not 5%, not 8%, 12%. The Fed raised interest rates again. Okay, they raised interest rates again on their December 15th thing. So they didn't care that the market was down. The stock market was down 15%. Down 12%, and they knew it would go down further. The only reason why they changed was a couple weeks later, very short time later, credit spreads started widening out. They had a big problem in the credit markets. The high yield market started imploding, and that's when they moved in because they were worried about the system. Now, they know that if the stock market really falls hard, the same thing will happen because that's what happened in March of 2020 when the pandemic hit. But now the market the economy is so much stronger, the banks are so much stronger, et cetera, that a 15 to 20% pullback, especially if it's not all at one time, will be very unlikely to have that same kind of impact. So do not watch the stock market. Do not, be honest with you, I do think it'll see a nice bounce off the 200-day moving average if it falls that far, but it could and probably will break below it, in my opinion, at some point this year.
Hey man, really quick here, we have a couple of questions about the chat room. So there's no syllabus. It's pretty much live trading. The live trading is done in the chat room, Tony, and Matt is basically giving you education within that trading. So you have a weekly session as well, every Tuesday for about 20 minutes or so. So that's like a recap. It's just for chat members. There's also a laptop included, and you get some scanners and some charts. I'll go over that later, Tony. But yeah, it's pretty much live trading. Matt is just like giving an overview of the market, and as a chief market strategist, what he's looking at, what is happening, right? Value is asking, where is the link? I'm posting it in the chat room. What's up, Matt?
No, I was going to say, we can go over a number of different stocks that I've got written down here that we can talk about, or stocks that the other people want to talk about. We'll
go into it. We'll go into it.
And I just want to give it, an idea of what I'm looking for and why I'm looking for it, because so many people on Wall Street are paid to be bullish. And that's great when it's April 2020 and the Fed is providing massive amounts of liquidity. Now they're still, oh no, don't worry about it. Don't fight the Fed, don't fight the Fed. Suddenly the Fed changes and they're like, well, that really doesn't matter. And it's an old saying, don't listen to, it's hard to convince people of something if their job depends on not believing it or not understanding it. And these guys, right. Sometimes it's subconsciously, but other times it's conscious. They know it. Their job is, if you work at a money management firm, if you work for a Wall Street firm, your job is to keep as much money, bring assets in and keep it in. And therefore you have to remain bullish always. For me, luckily I work at a firm where they let me say what I think, and that's what I do. And I think this is going to be kind of a key time. And that's why I wanted to give that big overview, because I really do think it's going to be an important time in the market in the next year.
Right. And guys, there is a 7-day money back guarantee. So, what you are seeing Matt doing is pretty much what he does every day in the chat room for all the members there. So, if you think this is cool, then imagine doing it every day. But keep in mind, this is a chat room just for verified traders, verified people. There's no fake accounts. There's no bots. Before anything, though, I do want to congratulate Joe and Jessica here for signing up for the Stock Picks Inner Circle chat room with Matt Maley. So they're going to be with Matt. You have access immediately, guys. But keep in mind, this is live trading. It has education as well, as Matt is giving you. For some of you guys, it might be even too advanced, maybe, but that's part of it, right? You do want to surround yourself there.
Right. But I say it in capital letters, as do other members of the chat. There's no such thing as a stupid question. Ask
Right.
away. I said, you know something, you might as well be speaking a foreign language. I have no idea what you're talking about. Great. And in some cases, maybe it'll be, you know something, I'll talk about this at 4:15. We were in the middle of the trading day, and it's not something we're going to, it's actionable right now anyway. It's something that we're looking at over the next couple of weeks, and then we'll sit down and I'll go through it in a better way. Or we'll talk about it in that weekly Zoom call we do at 11:30 on Tuesdays. I tried it this week. We didn't do it because there was so much going on in the marketplace. But almost every week, I'd spend the first part talking about about one specific area of technical analysis, and just talk about head and shoulders pattern. Why is it important, and what does it look like, and explain why it's more than just a bunch of lines drawn on a chart. And then we go off and talk about individual trades that were ideas we've had that so far this week. We want to have, and that's why we have it on Tuesday rather than late in the week, because we want to be like, okay, if you have it on Friday, what good is that? I only got 3 hours to work on it. Let's talk about these things on Tuesday so we can set up and number one, act on them now, or at least set ourselves up for later in the week when some sort of actionable, potential actionable, we see, hey, this is they're going to report earnings. Their CEO is having a conference call, whatever. We're trying to set up for the trades later in the week.
Okay, and Coach asking, is there a way? So I'm just going to go through these questions as quick as I can here. Coach asking, is there a way to ask questions about trades and ways to unwind them? Yes, you can do that, Coach. From Jadon is asking, how many trades on average would be suggested there on a day? It depends if it's a hot day or if it's a slow day. To be honest, from Jadon. Mbaye is asking, will he offer trainings on there as well? Well, you just heard the man, right? He's given in the sessions, he's also able, to do that as well. It really is. I mean, it's for active trading, guys, but you can ask Matt, what he thinks is a good long-term value investment, because he's been doing it for 40 years. So it's whatever you want it to be. Majida asking, will we be able to use our own brokerage like Schwab? Yeah, this is just for you to get your trade ideas, to have your community where you can trade with Matt. And there's also some scanners and stuff I'll show you guys later. But yeah, how would you answer that, Matt? What time does the chat room open? Someone's asking, what time does the chat room open?
Well, I mean, we get going around 9 and close around 4:30, but like tomorrow we'll be talking. I mean, that number comes out at 8:30. We'll be talking at 8:30, and because it's, the market's not open, but we'll do some setup things. And like, for instance, on Mondays too, I usually send out a kind of like a preview of the week. what these are the companies that are reporting earnings. These are the data points we're going to worry about. This is when such and such Fed leader is speaking. This is when the Prime Minister of Japan and the U.S. President are meeting, whatever it happens to be, and try to get actual, so they kind of have an idea of what's going on that week. But yeah, it's really mostly during the trading hours, about a half an hour before trading starts at 9:30, and then a little bit after. And then, but if something happens overnight, which I'm sure, it really hasn't happened that much, but if and when it does, and I'll do it from home at midnight. I mean, that's we'll talk about those things. But yeah, the thing is, one thing I want to just mention, this whole thing with learning, and I one thing that's really, I think, important, a general thing that nobody really teaches on Wall Street, and I really don't know why, but is when you're investing in something, especially, I'm not talking about the options now, I'm just talking about you have a real good idea, something you really believe in. And for whatever reason, it might be you work in the industry, you work at the company, your brother or your sister or your daughter or your son works at this company, and it's just unbelievable. And they're telling you, and you check it out, and it's like, oh my gosh, this is great. This is the newest thing. I want to get into it. So what happens though? What all too often happens is that, again, we still want to time things a little bit. All this stuff about Warren Buffett not being a market timer is a bunch of baloney. Okay, it's just, he's not really, but it's all long term. He's like, when things get washed out, that's his timing. It's not like I'm going to buy it here for a little, but he's like, I want to buy it now when the stock is down and washed out and everybody has given up on the stock. Maybe it's been hit by margin calls or whatever. And he goes in and he buys the stock, and then he holds it for a long period of time. Okay. But, and then for the rest of us, you might like the same thing. If stock gets knocked down, maybe there's some sort of investigation, it turned out to be nothing. Well, fine. But when you buy a stock, especially you really like it long term, and you don't be afraid to keep buying it. So many people, oh, geez, I bought that stock at $20 and immediately went to 25. I didn't really buy as much as I wanted to. Then I went to 30. God, what? I'm like, Well, first of all, a lot of people, if you really like it on a real long-term basis, as money comes in, maybe each month you take some and you put it in, that's fine. But the other thing is that as a trader, and even as a long-term investor, if you buy a stock at $20 and it goes to 30, do not be afraid to chase it. Okay. Now, buying it on the downside is not good. Okay. Now, don't get me wrong. You buy it at 20 and it goes to 21.70. You want to buy some more? That's fine. Nothing wrong with that. But a stock goes down 10%, that means it's not working. Now, get out of the stock, cut your losses, and look for another opportunity to get in. It's risk management is so, so important. But also, but think about it too. You buy a stock at 20 and it goes to 10. And you're like, boy, I really like this story. So you double down. Great. So my average price is now 15 because I bought half at 20, half at 10. My average price is 15. The stock's trading at 10. Okay. You've got a losing position. You just doubled on a losing position. Now you're relying on hope. Hope is not an investment strategy.
Right.
Look at the other way. You buy it at 20, it goes to 30, and you double down. Now you have a stock where you're bought at 20, the other half at 30. Your average price is 25. Do math. 25, and it's trading at 30. You have a winning trade. I mean, now you can't lose. When it gets down to your cost level, you use a stop out and you get out. I mean, again, they may announce bankruptcy.
Hey, Matt, From Jay is asking how many average, I mean, coming from you, right? How many trades in a day, like an average, considering all, like just as a general idea, something they can expect just from the chat room itself?
Well, I would say, it's funny for me, I'll give several, and I will say, 4 or 5. Today, I only gave a couple because the market, once it opened in a big way, it traded sideways like I thought it would. In fact, I said to the chat room, I said, sometimes the worst thing to do is don't just sit there, don't just sit there, do something. It's like sometimes the right thing is don't just do something, sit there. and that's what we want to do because we knew this employment numbers coming out and we've already had this big move this week. So today we did some things on Microsoft and Triple Q. We're kind of the two main ones today. We talked a little bit about Tesla as well. But on most days we're trying to do, 4 or 5 for me, but I get asked about 20 stocks. It just depends on the day and the movement in the stock market. But I'm talking, I mean, we're we get all day long. I mean, obviously I do things. I mean, today I was on the CNBC at 1:30, so I was obviously off the site for a while. I do Bloomberg interviews. I was actually on a TD Ameritrade network as well today at about 11:30. And I get lunch and I get busy with other things, going to meetings and such. But I try to stay on here, and when I get back, try to answer all the questions. And sometimes I miss a few, but we talk about a lot of different stocks. And the key thing is, it's not just my ideas; it's other people's ideas that we hear about, and we react to, and I react to, or other people react to. And when I'll sit there and say, "Holy cow!" We were talking about Microsoft. It should really rally nicely here. How in the heck I didn't think about NVIDIA as well? I have no idea. Somebody else mentioned. I was like, absolutely, that's a great call. Let's look at that one. And when it's the market opens higher tomorrow, if you get a number that helps the stock market rally, you ought to be looking at the short-term trade in NVIDIA, because this stock's also been hit pretty hard too. It bounced back, but see here, it broke below its 50-day moving average. That's a concern. But look at this. It held again. See how this? Look at that level there. I'm going to get rid of those moving averages. And look how it's held this level. 1, 2, 3, 4 days in a row, and it got close to it 2 other days in just the last couple of weeks. So if this stock's going to 300, if we get a rally tomorrow, it's going to open higher. That's okay. But we're gonna try to run this one, take advantage of this one for a move even higher. However, again, like I said, we're not in this one. But if it breaks below this level, which is, again, these are intraday lows, which is basically 272, breaks below 272, and it's really bad. And we're going to look at it for the put options, because this stock, again, we're in a really volatile environment. We want to stay nimble. And for some people, that's like, hey, I don't have time for that. And I understand that you shouldn't do that. Right now, I would say on a longer term basis, see, the stock is not very oversold, and it's very, very expensive. And I think it probably will break this thing one day. This is going to provide, don't embrace it. Embrace the volatility, because that's where you make money. That's how you make, when people are throwing out baby with the bathwater. But again, look at that 200-day moving average. Okay. Look how, well, let's get rid of some of them so you can see it a little bit better. Okay, look at that. Rock solid support March, end of March, again in May. Now it's way above it. Now it's not going to go down there tomorrow. I think eventually we can trade around it. But for those who like the stock and you own it, you should hold on to this. This is a great company with great prospects. But I'm not loading up on this. I'm not adding to this name right here if I own it long term. Okay, and maybe add a little bit here and here, but you back up the truck if it gets down to its 200-day moving average. Now its 200-day moving average is basically $215, right? It'll be higher because even though the stock may come down, it's an upward sloping. So maybe it'll be 220, maybe it'll be 225 when you come in when the stock comes down that far. But that's going to provide, especially if it spikes a little below it, that's going to be. Well, let's see if I can tell you here. Let's see something here. Look at. Let's see if I can. You can't. Well, you can see here. It's hard to see, but you see how this is the volume. See how the volume was higher? This was the volume spiked only because of an expiration. That's not an options expiration. Here it was higher for several days. Why? Because the stock was getting washed out. High volume sell off, like at the end of a sell off like this, high volume. I'm like, oh gosh, you got high volume getting washed out. It broke slightly below its 200-day moving average, but it's a lot of high volume. It's oversold on its RSI chart. This is a great time to buy it. Boy, the stock just rallied. So that's what I'm going to look for here. The stock. We're going to see another big volume. Right now it's volume. So that's why I think it's mini washed out, could bounce tomorrow. But you get this thing down to its 200-day moving average, down to its thing. Then we're going to back up and buy it with both hands. And remember, I know the market's gone straight up since March 2020. That's not reality. And as I said, the Fed's job is not to keep the stock market constantly rising. Yes, the economy stock market is important for the economy. They do not want to see it go down 50% like it did in 2000 and 2008. And they will step in, I believe. But I just believe, based on what they're saying, talking about froth in the market, talking about concerns over inflation, they are willing to let it drop further than they have in a long time. They couldn't do that in 2020 because the economy had completely shut down and the credit markets had completely frozen up. They had to come in. It wasn't because the stock market was down; it's because the credit markets were frozen. Okay. And the same thing happened in 2018. They let it go down and they were fine with it going down and they didn't care if it went down further. It wasn't until things got ugly. I think they'll do the same thing this time. They won't want to let it go that far, but I think they're confident in that with what's happened over the last 12 years, that the system is in much better shape and will be able to withstand it again because the economy is doing well. Remember, usually when I'm going to get on my horse here and start talking too much about this, but when the economy it was got fairly valuable when the stock market is way overvalued. It's overvalued now. It's extremely high valuation. Usually it gets a little high and the economy is doing well. And then all of a sudden the stock market's going down. It usually goes down before the economy does because it sees something in the economy and the economy comes down. Right. So they both go down, with a little bit of a lag, they go down together. This case is scenario, but it goes down. The market goes down. The stock market goes down because it sees something in the economy and then it gets confirmed. And so they both go down together. This time around, the economy is doing this. The stock market's not going to come down because the economy is doing this. As the stock market comes down, the economy should flatten out a little bit, but it's still strong. The reason why it will come down is because it was pushed artificially high because of artificial emergency of COVID. They need to let it come down. The Fed wants it to come down. I'm telling you, they do not want another 2000 bubble. We are in a corporate bond. There's about $11 trillion of corporate bonds out there. If we have another bursting of a bubble, we have a big problem. They cannot afford to have another bubble. Okay. So as much as people try to say they can't afford to have the market go down, they're wrong. They can't. The bigger issue is that they can't let the market take off like it has in the last year. They need to let it come down. And it doesn't mean it's going to get crushed, but again, I got to go back to the point of the leverage. All this leverage in the marketplace, we will get situations where we get margin calls, forced selling, create great opportunities, and not just great opportunities like I think we'll get in Microsoft tomorrow to be able to buy it on a pop. However, is it will also, much more importantly, when these stocks get down to like their 200-day moving averages, it'll be an unbelievable opportunity to buy the stock and sit on it for years. So this is, again, what we're trying to do. There's nothing, I understand Wall Street and they're always focused on only the fundamentals. And how many times I had a person say, this doesn't make any sense. The fundamentals are great. Why is the stock going down? Or last year when the GameStop was going up, I was saying, this guy, what the hell's going on here? These guys, GameStop's not going to come up with a vaccine. They're not going to come up with the next iPhone. What the hell is going on here? Well, other factors, the short, the meme style, the short covering squeezes, the Reddit traders, etc. That's what we try to focus on because it causes these dislocations, and we want to be able to take advantage of them. And that's why I try to help people learn about what's really going on in the marketplace. And it has a lot more to do. And I know so many great analysts on Wall Street who cover certain areas and certain stocks, and they're very, very good, and they're very, very important. I listen to what they have to say because the fundamentals, in the end, it comes down to the fundamentals. The great thing is that dislocations come up from time to time, and that's where you really make the big money. Not, I don't want to misstate that. Some people, believe me, there's people who bought Microsoft in the 1980s and never sold it, and they're retired very, very comfortably on that. So I don't want to overstate that. But my point is that the big players, the guys, these private equity guys, the Warren Buffetts of the world, the hedge fund guys, they're the ones that come in when there's, they say, blood in the streets, is the old saying, blood in the streets on Wall Street. They come in when nobody else. And the reason why is they see what's coming. That's another thing just to talk about. Psychologically, I do believe strongly that everybody should raise a little bit of cash here. It doesn't mean going 50% cash, 110, 5 to 10% cash. It's just a good idea. If I'm wrong, you miss a little bit of the movement, then we'll realize we're wrong in a couple of months, and you'll get back in, and you will not have missed much at all. However, if the market does come down, and we do see a deep correction, the market's down 15 or 20%, those who are margined, who have leverage, are going to get margin calls. But even those who don't are going to start to panic. They said, "Oh no, I knew I should have sold when the market was." That Maley guy was telling us that the market was out of control here. I should have sold, and so then they're selling at the exact wrong time. They're panicking when they're losing their heads when when the real smart guys are keeping theirs. And what happens is that so if you have a little cash, that gives you the confidence to go ahead and buy when the market's getting washed out. Number one, because you don't have the big. But number two, you also, if you've made a few trades on the downside, you've not just tried to weather the storm, you've tried to profit from the storm. Now you've made money in the decline. You're like, wow, I am really confident now. And maybe you don't, it's the smart thing to do is avoid trying to catch the absolute low. But you're the one, the market bottoms and rallies 20%, and some of these unbelievable stocks like Nvidia and Microsoft rally 60% in a couple months. You miss the first 5%, you don't care because I want to miss that first 5% just to be sure the rally's going to hold, and you run. But you know what? Those people who don't have any cash have not made any money on the way down. They're the ones who sell at the bottom, and then when it rises 5%, they sell again, and you'll be the one buying. And it's just trading is such a investing, not just trading. Investing is such a psychological thing, and the contrarians tend to do the best. And this is a time frame. Again, this was not something you would have said in 2015, but but it is something because of this big change in policy that. And again, like I said, with China kind of doing the same thing, it just kind of makes sense. And anybody who tells you the market's always going to go up. Market does go up over time. It's inflation. We have a fiat currency. So having a lot of money, a certain bucket that just you sit there and let it run for a long time, that's great. But there are opportunities. And since the Fed has changed their policy, number one, and number two, since the tools are there for us to take advantage of it, finally, I think this is going to be an unbelievable year.
Interesting take there, Mr. Maley. So, I mean, I know that you're like most people in general, like on firms, they're like equity strategists, right? But in your case, you're a market strategist. So, I mean, you do have an overview of the global markets, and then you always just bring it back to the U.S. stock markets. Someone was asking, what kind of stocks do you trade? U.S. equities, for the most part, weekly calls, right? You're trading volatility, regardless if the market's going up or down. The feedback that I get from the people in your chat room is that, they're very thankful that you take the time to help them out with this and give them good trades, because ultimately, retail traders have always, they'll go to TikTok or Reddit, these places, and being able to have somebody with 40 years in the industry that has been doing this professionally, it does mean a lot, because most people don't know where to go, where to turn. And they do get a lot of value from your service, where you help them, you give them feedback on their trades and stuff. So getting feedback from a chief market strategist I mean, that's something that you only get here with Benzinga, pretty sure.
Yeah, that's obviously our goal. And again, like I said, it's not just picks. It's education and trying to really help people move ahead. And sorry, I keep using the same term, but maximize your profits. And it's and my side is not. I mean, my side, is our site is not one where we're trying to get every. I mean, if somebody says, "Hey, I hear a rumor of this," I'm like, "Yeah, I don't know." What do you think of that? I hear the rumor that so and so is going to buy. I'll just say I have no idea because I don't have any idea. If I did, if I did know and I didn't have information, I wouldn't give it because I go to jail. I have no interest in doing that. But and that's what some of these people do. They come out and they say, "Oh, I hear this and this," and geez. But if somebody has a really high short interest, I'll say, "Yeah, okay, there's really high short interest, and it's bumping up against a really tough resistance level. If it breaks below that level, it's probably going to get squeezed." But those are the types. Yeah, I definitely look at those. But and there's all sorts of other opportunities, especially on the technical side of things and positioning, that you can really take advantage of. But racing around just trying to get sucking other people, and geez, I just bought a lot of stock, so let's see if I can run the stock by going out and talking bullishly on it or spreading a bullish rumor on it. That's not what we do. That's certainly not what I do, and I'm not seeing anything. And we're not seeing that at all in the thing in the site. And I'll tell you too, and sometimes people ask me what's going on with the stock, and I'll look around and I'll ask around, and I don't know why. I'll just say I don't know. I'm not going to make something up. That doesn't do you any good. I don't have all the answers by a long shot, and I mean obviously nobody bats 1,000 in this business, and in Major League Baseball, if you bat 300 or 350, you're going to get paid tens of millions of dollars. In the stock market, that's your batting average. You're not going to do very well. But you're not going to bat 1,000 either. And so we're looking to bat 700, 800. And the big thing is that if you're batting 700 and you cut your losses and keep them at a minimum and let your gains run, that's when you really you feel like you're batting 1,000 because. And that's the other thing too. I've done several times where people have asked me about a certain trade, and I just said, I don't like it here. I mean, it's had a great run, but it's overbought, and I wouldn't, Ford Motor. This was one we tried, and look again. It was one that looked good for a while, and some people did make some profits on it. But here is a stock. It's a great stock. I mean, it's a great company, but the stock is overbought. Look how overbought it is here. And we also have. I looked at the Bollinger Bands. What the heck are the Bollinger Bands? Well, I'll tell you. The Bollinger Bands. Okay, they measure a stock sheet. They take the 20-day moving average, not the 200, but the 20-day moving average. Okay. And they take it. Okay. When a stock gets 2 standard deviations above its 20-day moving average, it gets above the purple line. When it gets two standard deviations below its 20-day moving average, it gets the orange line. See, well, that's been a nice short-term pop. Now here it eroded, but look at look how overbought it is. Look how extended it is above its 20-day moving average right now. If the market gets hit tomorrow, I think Ford's going to get crushed. Look how much more extended it was than any other time in the last year. Here, each time the stock went down for a couple of, several days, if not a week or two, even though it's a great stock and heading higher. So we've looked at these puts, and this one, it didn't work out today. And again, it's one that I think, and again, it could just end up just kind of trading sideways and everything will catch up. That could happen. They've really done a lot of great things. But whether it's tomorrow, again, I didn't really double down on it because I do think the bond market will be stock market friendly tomorrow, but it still could go down, and because it's so extended, and I think it will actually. But I'm not pounding on the table as much as I was yesterday. And even when I pound the table, I'm not obviously not always right. But this one is still very, very vulnerable based on this. Again, look at these. Okay, look at these. And it went down for at least several days. This one is kind of fiddling around up here. At some point, and it doesn't mean it doesn't mean the stock's going out of business. Doesn't mean they're Tesla's going to blow them out of the water. It means that the stock is too extended on a short-term basis, and we want to take advantage of this dislocation. So that's So that's again, these are the types of things we look at. That was another one we looked at this week. Didn't work out as well. I think some people made a little money, some people lost a little money, but you can see it didn't really go away from us. Didn't run away from us to the upside. So it wasn't a one that hurt people too much. But again, like I said, some of these picks don't work, and we try to get out of them as quickly as we can when they don't. I just want to see one thing. Well, let's see here. one thing I do want to talk about is in a longer term basis, and for this year, is the consumer staple stocks. And these are not sexy stocks. You're not going to make 60% of your money next year on the stocks, but they do pay good dividends and they're outperforming. So don't be afraid to look at stocks, especially a stock like a Walmart, which hasn't done anything in a while. And it's been kind of a dead stock for the last year, but it's a great management. And let's face it, if we have an inflation, more people are going to go to discount retailers, and they have an unbelievable .com business. If we can buy stuff, my wife and I, if we can buy stuff at Walmart, we buy it there. If we can't get it, then we go to Amazon because we get it faster and usually at a better price. And so they've got the internet thing hitting very well. But a lot of these names, they pay a good, strong dividend. And the thing for that is, if we have a market, even if it doesn't go down, if it only goes up a small amount, and you're not making your 10 to 20% like you've made in recent years, you can still get paid while you wait in these stocks, and they will outperform. And in fact, they've been outperforming the XLP Consumer Staples ETF. And the reason for that, in my opinion, is that institutional investors have been saying, oh my gosh, see how this nice rally here to December? They realize that what the Fed's doing, and they say, well, I can't afford to sell all my big cap tech names, especially the mutual funds. Some of the hedge funds have been dumping them lately, but the mutual funds, because they've done so well for so long, I'm going to hold on to them for longer. I mean, they may pare back their positions, but what are they going to do with the rest of their money? They can't put it all in these stocks. And now they're like going, well, if I'm wrong, I better get into some of these consumer staples. Number one, they outperform if the market does correct, certainly if it gets a bear market. And they can even go up if the market goes down. In fact, this group, is boring stocks with Procter & Gamble and Colgate and Kellogg's and Philip Morris and these things. They all, these stocks do have, they have done since December 1st. No, it's only 5 weeks, but they've rallied twice as much as the S&P, twice as much. Okay, because these people are using this barbell approach where they're still sticking with some of these growth names, buying these consumer staples because they need the safety. And if the smart money's doing it, why shouldn't we be doing it? Now it is getting a little overbought, so I'm not going to get chasing it too much. And if the overall market comes down at some point in the next couple of weeks, this will come down as well. But it should still outperform. And as the market goes back up, because people will be worried that the worst isn't over, they'll go, believe me, they're going to go, as we're buying in NVIDIA and Microsoft after they go down to the 200-day moving averages, we're going to be buying some of these names too, because they're going to, again, they're not going to go up 60%, but they're going to go up 20% in a matter of weeks. And we're going to make some nice money. And then on our core positions, we're going to get paid with nice dividends. I mean, Philip Morris, now, if you're against it, I totally understand. It's actually not Philip Morris anymore. What do they call themselves? But Atria, I think it is. But I mean, look at this stock. It's like Atria Group. It's a 7.3% yield. I mean, this stuff that legal issues seem to be behind them anyway, and been for a couple of years. They're paying a 7% yield. You know how much it costs to make a cigarette? It costs nothing. And so this is a company that's it's a good place to hide. And again, if morally you're against it, I understand. I'm certainly not a smoker, neither is anybody in my family, but it's just something to look at as long as you don't have a moral issue with it. So, but these are the types of things that again, we're looking at the longer term, short term. Don't be afraid to look at some of these boring stocks, because you're looking back in history. History has not changed. Okay, bear markets, corrections have been going on forever. We want to make sure that we take advantage of them this time around. And by doing that, you can, the old traditional way, when you couldn't buy options that expired on a weekly basis. All you could really do was go in and buy some of these stocks. But it's funny because the institutional players are really starting to play in these names, which I think is smart on their part, and I think it's going to work very well for them. And why not go along for the ride? The other thing I would just mention is gold. Now, if you like Bitcoin or other cryptos, I totally understand. But just, gold has worked for 5,000 years as an inflation hedge. And I just don't want to give, I don't want to throw this one out the window and say, let's forget about the yellow metal. Again, when something has been around for 5,000 years, you want to pay attention to it. And you see right now, what I'm looking for is I could say it's, again, let's get rid of these. It's funny because death cross and golden crosses don't mean much in this commodity. They actually have not worked very well. That's, again, another thing you have to do is that certain things in the technical analysis work for some and don't work for others. Some assets and don't work for others. That's why you're always looking back in the past, saying, did this certain thing work or not for that asset? But here, this is what's called a symmetrical triangle. But you can see you could just say the trend line here is moving higher. I'm sorry, been moving down, obviously, since 2020. When we had that kind of flight to quality thing, but this is what's called a symmetrical triangle. And but what I'm looking at right now is to see if this thing can break out of that triangle to the upside and also make a higher high. So if it breaks out of that thing, it's going to be very positive. If it can make a higher high above basically 1880, it's going to be really bullish. Okay, look at this rally in gold. Look at this rally in gold. People sit there and go, I don't care about gold anymore. It's not. Again, if you want to be active, if you want to say, no, I don't want to buy it in my long term, that's fine. But if you want to be an active trader at all, active investor, you be willing to look at anything. And I'm not saying, oh my gosh, you got to buy gold because Bitcoin is a joke or Bitcoin is some sort of a farce. I'm not saying that at all. I'm bullish on Bitcoin long term and more bullish on Ethereum. But we want to make sure that that we take advantage of any opportunity that may come, and gold and silver will present opportunities. And not only they have in the last year. So let's take advantage of those. And just one thing I said I was going to talk about, and I'm going to mention it now before we go into some tickers here, is the technical analysis and why is it important? Okay. Again, you think about it, it is fundamentally based, and you get the people who are the portfolio managers in some of these long-term mutual funds, and they only look at the fundamentals, and that's great. So some of these people have been, Will Danoff and Fidelity, unbelievably successful, but you do they will be the first ones to tell you that, like I said earlier, when the economy rolls over, the stock market usually rolls over a little before it. When the stock market comes out of recession, when the economy comes out of recession, the stock market usually leads it out by about 6 months because they see it coming. The same thing happens with individual stocks, and that's why I love to use technical analysis. Think about it for a second. If you're in a company, if you're looking at a company, looking at a stock, and the company's been doing lousy for a couple of years, and they've laid off people and they've closed their factories and whatever, and all of a sudden they see that they're sales are picking up and maybe they've got a new product, whatever it happens to be. And they say, oh my gosh, so we've got to go out, we've got to hire more people. We've got to retool those factories. That takes time. You can't do that overnight. So those, you're not going to get increase in earnings for 6 to 8 months, or maybe 6 to 9 months, or maybe a full year. But these mutual funds, these hedge funds who have an army of analysts, they're going to see this in advance. They're going to be talking to the company. They're going to be talking to the company's suppliers. They're going to be talking to the company's customers. And they're going to see that their prospects are picking up and their earnings are going to turn higher soon. So they go into their portfolio manager and say, buy the stock. And they do. And so, but we don't have an army of analysts working for us. How do we see it? Well, we see it through technical analysis. We see that the stock is moving up early. And so that's, again, so you can see that it is fundamentally based. It's not just mumbo jumbo lines drawn on a chart. Some of it, they do get too complicated. And believe me, I sometimes I think they just do it to justify their existence. They almost make up stuff. But and we try to keep it relatively simple to the main things that really work. And it's really worked well for me over the years. And like I said, all of the best hedge fund managers in the world use it to a degree, one degree or another, usually to a fairly high degree. So it's something to
really quick here, Matt. Some people are asking if you only do options. I let them know that you do stocks, options, and crypto. You're a chief market strategist. You're numbers guy, Wall Street guy, but you look at things from the retail perspective, the smart way, right? We don't have 40 years. Retail traders don't have 40 years working at Merrill Lynch or any of these places. So the fact that you're able to bring in fundamentals, technicals, market analysis, everything put into one trade idea, right? Or trade ideas. That is really the value I see, because you can't pay for 40 years of experience trading in from inside Wall Street.
Right. That's, I mean, and definitely, we definitely look at individual stocks, and I do need to do more of that actually, because sometimes people get so wound up with some great opportunities near term, but we definitely have the short term trades we really want to. I'm sorry, the longer term trades and the longer stocks. I mean, I'll tell you one here. I'm going to put it up here real quick, and then we're going to go to see what you guys want. To some stocks that you can ask about, so I can look at that. Hold on one second. Let me hit escape. Okay. There we go. Oop. Let's see if I got the right one. Nope. Oops. Hold on one second. I apologize. Well, that was that today. No wonder. Okay, now I know what I'm doing. I'm sorry. I seem to have lost it. Maybe this is it. No, that's not it. Well, I'll just pull it up and I'll just go to the very beginning and see if I can find it. Okay. Apache, which is now I think called APA. Here's a stock that I love longer term. Okay. Look at this. Look at how this is, what we see is called a MACD chart. And what that is, I mentioned the 50-day moving average, these golden crosses, the 50-day moving average versus the 200-day moving average. And when it crosses to the plus side, it's a golden cross. When it crosses to the downside, it's a death cross. Obviously, golden cross is bullish, death cross bearish. But this is the same thing, but only on a shorter term basis, and it's called the MACD. And this talks about the 9-day and 12-day exponential moving averages. And when they cross in either direction, especially for certain stocks, for most stocks, not all stocks, but most stocks, and you can see here that it saw a very big positive MACD cross here. Saw it here, look what happened. Saw it here, then broke to a new high. Here, I think we're going to eventually break to a new high and going to take off. Here, another big rally. Here, another big rally. We also see that it saw corrections when it saw negative MACD crosses. So these are the types of things where it got, we owned it, because we liked it here, we got it up here. You go up here. This is one of the stocks to say, hey, the next time it breaks down, sees a negative cross, I'm going to say, hey, okay, let's cut back our exposure on this one. But this is one I really like on a long-term basis. It's getting a little ahead of itself on a very short-term basis. Let me see here. I'm sorry, if you can see this better. Hold on here. There we go. But so you can see it better. But you see how these things work. This is a weekly chart, as a matter of fact, and really, really bullish on this stock. And again, like I talked about earlier about energy and how we're just not spending enough money to get the supply out of the ground worldwide enough to meet demand. And it's just the energy stocks. We have Goldman Sachs and others saying it could reach $100 very soon, like even by the end of this month, some people saying. So I really like this group. And these are the types of stocks that I talk about. When Chevron's another one, which when we got into that name, it was still paying a 7% dividend yield. That was over a year ago, and we just ridden that one out. It's been a great stock. So those are the types of things that we really look at, and so I definitely do look at individual names as well. And in fact, I want to be doing more of that in the future, because sometimes we get a little especially when the markets are really volatile, we start really focusing on some short-term opportunities. But maybe we can go.
All right.
Rodrigo, to some names here, so I can.
Is it time?
Yeah, it is, because I got it's.
All right.
I've been doing this 2 hours, so it's good. And
Yeah. No, just to keep in mind, guys. I mean, we're supposed to finish here at 5 p.m. So, anything here is just out of courtesy, guys. All right, guys, go ahead and put your tickers in the chat. Put in one ticker per person, no spam. We're gonna go over a couple of these in the chat, and then Matt is going to follow up with these trades, if there is a trade to follow up with at all, right, in the chat room with the folks there. All right. So the first one we have there, let's see, they're coming in hot. Okay, I think you've done this a couple times, Matt, but go ahead. MU.
Oh, Micron. Yeah, this is interesting because the stock. Oops, my screen just froze up. Don't worry. Sometimes it does it. It'll come back in a second. Just give me 2 seconds. But yeah, Micron. This is a really key technical juncture. I love the stock longer term, but it's a very volatile stock. And when I say volatile, I don't mean volatile bouncing around like Tesla does. And some
Is
days
it in your chart?
Yeah, just give me a second. I'm trying. My thing is my screen's frozen. So give me a second.
Okay.
There we go. Here we go. Okay, now this stock sees big swings on a weekly basis, not necessarily intraday basis like some stocks do, but this one Okay. Bang. See how this one here, we got a couple of things that are going on. And some of them are bullish and some of them are bearish. So it's, like I said, a key technical juncture. Number one, on the bearish side of things, it's testing. It can't seem to break above its highs from April. See, it got up to it a couple of times. It can't break above it. This makes me worry that maybe it's going to create a double top, and double tops are not good for any stock. Okay, but it hasn't come down yet, so I'm not there yet. It's also, you can see on its RSI chart, it's overbought. Not as overbought as it was in November, so maybe it can hold up, but I'm looking concerned. Having said that, it just saw a golden cross, at the end of last month, at the end of the year. So I guess my feeling is this doesn't surprise me that it's been, because it's overbought. It's kind of dancing around this level. Is it working off this, kind of digesting these gains so before it really rallies higher, or will it fail? So what I'm going to be watching here is basically if it can break meaningfully above 97. It got above it in the morning yesterday, but couldn't hold above it. If it gets above it, especially if it gets above 100, this thing should really run because it will make it a new high. Nothing more important than in technical analysis when you get stocks with higher highs and higher lows, or nothing worse when you get lower highs and lower lows. This higher high would be very bullish, especially because it followed a bullish cross on its weekly. I'm sorry, that's its daily. I don't know what. Yeah, that's right. This is the daily. I'm sorry, on its daily RSI chart. If I went back further, you can see what it's done. So I'm leaning to the bullish side, but my concern is that the stock market. I'm a little worried about the stock market. So if the stock market goes down, but look at this. See when it got a bullish trade cross there. Look what the stock did. Bullish cross there, stock up. Okay, but look what happened when we got the negative cross. So it was down. So it works in both directions. Here we got a head fake. That's why we got to be careful. This doesn't look like a head fake. It looks like a real good move. Here was a head fake, and of course the stock kept going down. So that was dangerous. We always got to be careful, and that's something I try to look out for on the in the website in the chat room.
Right. Okay. Cool stuff. And obviously keep in mind that, like Matt will be following up with this trade wise in the chat room. Okay. Right now we're just scratching the surface because we need to get as many as we possibly can here for you guys. All right. Then we have Neo, Matt, NIO.
NIO
from
another
EP's
popular one.
Blue.
And this is what we do all day long. People ask, what do you think? What do you think? This one is, let me just go back a little bit further just so we can see it. 2020. Again, my concern is that it's a stock that is part of this whole thing with the excess liquidity from the Fed. The good, and so therefore, as the liquidity disappears, this stock is going to have a little bit of a tougher time. The good news, though, is it's already been washed out to a certain degree. And I think froze up again, but the stock's not oversold. But see how this level was so important. Again, there we go. Let me get rid of this. But it got down to here, the 30 level, and bounced. Got down to the 30 level and bounced. Now it's gotten below the 30 level a couple of times. It's bounced a little bit, but not really. And now it looks like it wants to go back down again. So this is a concern for me. And I just think, I don't think this stock is going to get crushed because I think it's been, it's already washed out a lot of the leverage that was in the market, the stock, a lot of the froth that was in the stock. But it's still one that I think you're going to get a better opportunity to buy this stock again. See how the MACD chart looks like it's going to roll back over. So what I'm doing, again, this is where we got a great opportunity. If it breaks below this level, okay, again, which is about 27.75, that's going to be a big problem because it will probably be a negative MACD chart cross as well. However, if it breaks above this highs here, which is basically $34, the stock is going to be its first higher high in a while, and that'll really be bullish for the stock. So we got the greatest thing about this one. Sometimes you just don't know. It's like, I don't know, this, like Micron, it's like it could go either way. This one could go either way as well, but we have definitive levels where we want to. It's like, well, geez, if you're going to wait till it gets to 34, why don't you buy it now? And I said, because I'm doing risk management. I want to be more confident in my bet. I don't want to just take a guess and hope that it breaks out to the upside, because if it breaks to the downside, I'm going to lose my shirt. So that's kind of what we're looking at for that one. But again, great long-term prospects, but I do think some of this froth, a little bit more needs to be washed out of the stock.
Okay. All right. Interesting. And let's go here with the next one. Also, risk management is a very big part of what you do, Matt, right? So like being able to properly assess that when you're making a trade. And
Right.
some people might expect like, some, how do I put this? Some really old fashioned just text trade alert, like buy here because so, like, and what we're trying to do here is a lot more explaining this is why this is happening and this is how you profit from it, so that they can actually know, people can know what they're doing, not just, subscribe to some text alert service,
Right.
nothing like that, more human per se.
Right. Exactly. Exactly.
We have here, all right, next we have from Joanne, we have Shopify, Joanna Deshawn.
Yeah, this has been such a tough stock.
Why has it been tough?
Well, it's just been getting killed. I mean, I'd say it's not tough. It hasn't been tough for me. I've been bearish on the
Oh.
stock, but you see, look at this thing.
I haven't seen the chart. Yeah.
Yeah, it's just it's broken down. The good thing though, it is a broken chart, a broken stock. And when stocks get broken, they usually don't do anything for a little while, but at some point, but again, look at this big volume that's accompanied this thing here. Let's look at it here. This big volume was a sell-off, right? This big jump in volume. Okay, that was actually Riley's, so you like that too, right? This big jump in volume, okay, bounced off the 200-day moving average. The problem here is that, like, again, in technical analysis, 200-day moving average provided great support. When it finally broke it, it's like, well, that looks like a problem. Oh, it looks like it's going to gain it, and then it fell. And then this move here, just did it in, and this is what's causing the washout move. So I think it's got more to go because it failed to regain its 200-day moving average. It's good that the volume is picking up. It's good that it's getting oversold on its RSI chart. Let's look at its Bollinger Bands, see if it's really getting enticing yet on a short-term basis. But I guess my point is that it should be a good one relatively soon, and a lot sooner. People say, well, when the market gets hit, and I've talked about it, we're going to buy NVIDIA, and we're going to buy Microsoft. Well, that's great, but guess what? Hold on a second. Guess what? The washed out stocks are going to bounce a lot more, and this is going to be one of those stocks. So, no wonder. I'm sorry. Let me do it again. SHOP, equity. Okay, now, yeah, this is looking interesting. Look enticing now. See how it's Bollinger Band? It's down below its that level of its 2 standard deviations. Look what happened the last time it did 2 standard deviations of its 20-day moving average. Last time it was there for 2 days, just like it has in this for 2 days, and then it bounced in a big way. Here it kind of rode the line, but when it finally dropped below it, it bounced nicely for a little while. Here, same thing, below it, bounced a little while. So this actually could be an interesting stock. Here it did bounce, same thing. You see that how many times the stock has bounced after testing that Bollinger Band. See here again. So, I'm really glad you showed that one. I'm going to definitely talk about that one tomorrow.
It looks juicy. It looks really nice.
So we'll see what happens with the employment number tomorrow. See how the market reacts. But if we get a bullish, and the thing is, if the market reacts really strongly and the stock opens up, this is so washed out that I think this will be one that we can still buy, even if it opens up 3 or 4%. Well, look, I mean, it's come down so far that it'll be a great. Again, this will be more of a trade, longer term on the fundamental basis. It's still got some issues, so you got to be careful there. But it really looking good for a short-term trade. Then I say short-term, a multi-week trade.
Yeah, and in case you still don't see it, this is pretty much like part of the value where you can have real-time stock trading, option trading analysis with Matt Maley in the chat room all day for options or stocks or whatever's happening. If something changed, like, I mean, there's some numbers coming out this week that happens often. We always have job numbers. We always have CPI numbers, and they're hot right now. Like, they're very important to know. So that's why having somebody on your corner that can like pretty much help you how to trade around these events. That's
right,
really what people need.
When the facts change, you have to change with them, and
yes,
and you got to be aware when they're coming. And if you don't know they're coming, it's fun. Sometimes you get something you couldn't possibly have known in advance, and you've got to still be able to react to that as well.
And it's real time, because if you think about it, like everybody that like in 2020 had a certain strategy. Like I remember where it was like, oh, just buy anything EV. Like all those stocks are clobbered down to the floor. Going back to prior, where like before everything began. So you have to change with the market, and if you don't change with the market, you'll just be left behind holding the bag for years and years. And I've seen it too many times, Matt, where I'm glad that something like this is out there where you're able to help all of these retail traders and stay up to date with the markets, right? Like to the minute with these events.
Right, exactly. And I just can't, I mean, what's happening now with the pullback on the market has happened, hundreds of times in history and hundreds of times in our history. And markets go down sometimes. And that's why I'm really trying to help people. And I'm not the end of the world. I'm not saying the U.S. is going to, break apart. Any of that crazy. Some of these people, they send out these advertisements, it's like, if you don't read this tomorrow, you're going to be, unemployed on the street,
Yeah.
begging for food. That's not what I'm saying. I'm just trying to say that there's likely to be a lot of volatility and some shaking out, and some of these stocks just got too far ahead of themselves, and it has, in the dot-com bubble, a lot of these companies never had a chance. They were never going to, but the ones that survived were great. This time around, a lot more of these companies are better companies. They're fine. They just need to come down in terms of their price, and then they'll create great opportunities. But also remember too, and we talked about the cryptos and the internet stocks craze in the late 1990s. And people, younger people, I certainly didn't realize it when I was a kid. People don't realize how technologically advanced the automobile was in the 1920s. It was, you're like, what are we talking about? It was life-changing, just as life-changing as an iPhone or any of that stuff, okay? There are people who've never been 100 miles from their house, never. And none of their family had never been 100 miles from their house, generations. And it completely changed their lives. And guess what? There was like 50 or 60 automobile companies. A few years later, there were only 3. A couple of decades later, there were only 3. In the internet stocks, there were hundreds and hundreds. And a couple of years later, there were several dozen. It wasn't like it was only 3. And the same thing with the cryptos. The ones that work are going to work really, really well. So just be careful. I'm not, and again, I won't go into the details now. We can do that another time. But be careful on the ones. There's nothing wrong with trying to trade it. But the world doesn't need 30 cryptocurrencies. The whole idea is to have kind of one, right? And so there might be a couple, and especially if they're country cryptos, currency cryptos. But it's when you have, it's just not, they're not going to be as many. When you have that life-changing something that changes the world, not everybody tries to get in, and only a few survive.
Right, absolutely. And let's see, we got another one. Seems to have a lot of people want to hear about this since you talked about it, Matt. AMD.
Yeah, Advanced Micro, great company, great CEO.
The next NVIDIA or no?
I think so, yeah. I mean, but again, here's a stock that is, it's come down. And look at this. Again, this could be a good one that's going to bounce. If the market bounces tomorrow, we get a good number, and this stock bounces a little bit, especially if it only bounces a little bit in the morning, in the first hour. Don't be careful about the first 5 minutes of trading. This market could do anything. But watch this thing. This thing, I think, wants to go back up to its 50-day moving average. See, that was old support. Right now, it's new resistance. It could go right back up to that. But again, I'm just worried that it's ahead of itself in terms of valuation on a fundamental basis. The chips, it's hard to bet against the chips. Everybody's bullish on the chips, but that's my concern, is that too many people are bullish on the chips. And they say nothing can go wrong. So if it breaks down, and this is what's called, this will be a great opportunity just to talk a little bit more about technical analysis. My screen keeps freezing up. I apologize. But see this low here? Again, we break below this low here in mid-December. That's going to give it a key lower low. But it's also, hopefully my little ball, okay. It's, I'm sorry. But it's also the bottom line of what's called a descending triangle pattern. And let's see if I can pull it up. Bang. Well, I'm having problems. Like I said, I think I've been on the site too long. But
it's okay, no worries.
This line goes down like that, and this line goes straight across. It's what's called a descending triangle pattern. If it breaks below that, it's going to be a big problem. If it breaks above this line, it's going to be very bullish. It'll break out to the upside. But I guess my point is that this is at a key technical level. Near term, I think the chances are very, very good that the stock breaks out to the upside. But I do worry that on an intermediate term, and a long term, I love the stock. But on an intermediate term basis, I worry that it's going to be, now you can see how it's like a descending triangle pattern there. And that's what, so if it can break out to the upside, it's going to be positive, but it's close to that downside. So as we go, I think we get a little short-term bounce in the next week or so, but as we get later in the month, keep a close eye on that key level, which is 130. You break below that, that's going to be some problems for the stock. But again, this is going to be one later in the year that we want to look at to take advantage of the volatility, buy at a great level, and especially if it gets down. I don't know if it'll fall all the way to its 200-day moving average, but we'll look at what would be the MACD charts that we talked about, the Bollinger Band charts, the RSI charts. I don't get too involved, but I do use several of them consistently, and that gives us a good idea when we can really get in and take advantage of it.
Okay, and Value is asking, will the chat room be via Zoom? So Value, the chat room itself, I'm going to show it to you once we're done here with Matt's presentation. I'm going to show you the chat room, the scanners, everything that's included, but the chat room is separate. The web session that Matt does every Tuesday is done live call, which is outside of the chat room, but obviously everything is found inside the chat room itself. So Value saying I signed up. Value, welcome.
Hey. Welcome aboard. Great to have you.
Matt, what do you say to all these people that maybe are like, I mean, I'm new. I don't know if this is for me. Maybe they might be a little too new. I understand you've been doing this for 40 years. Like that's probably like that's quite some time, So like if somebody's very new, how do they know if maybe this is for them, or like, what do you say? How do you put this to them?
Well, I guess the key thing for me is it's a couple of things. Is that number one is that I'm really trying to use use it as a teaching vehicle as well. And so you can really learn and be educated. And like I said, and we say it over and over again, there's no such thing as a dumb question. And so if you want to learn, that's the way to do it. I mean, a lot of people learn just by losing money, and that's can be a good way to learn, but it's an expensive way to learn. And everybody loses money. I mean, there's no I don't care which trader, the greatest traders, the greatest investors in the world have lost money, and in some cases lost a lot of money on certain investments, certain trades. Everybody will tell you that, and nobody bats 1,000. But when you get educated and going into it, obviously you'll hopefully be making money right from the start. Not you'll, again, like I said, you'll lose some here and lose some there, but net you're making money, and then you can really you see the benefits. And the more you get used to it, the more money you make, and the more the better you get at it. But just flying blind and listening to guys, I don't want to take shots at other rooms, and these chat rooms where they got 10,000, 30,000 people on it. Who are these people? What's in their best interest? Are they trying to get you to buy a stock so they can sell it at a higher price, or are they really think it's a good idea? I definitely, that's not what we do here. We're there to try to help people make money on every trade. Not everyone works. Be perfectly, absolutely honest, and that's just nobody can do that. But so I guess my thing is that we are here to help people learn, help them make money, but also I guess the most important thing is there's so many things on Wall Street, so many old sayings, so many rules on Wall Street that are not right. They're not good. I mean, again, I'm not saying anybody's, using them to purposely, fool people. It's just that there's these certain things that make sense theoretically that everybody follows. And the ones who really make the money are the ones who say, that makes sense most of the time, but there are times when it doesn't, and when it doesn't, it really creates a great opportunity. And I want to know in each case, each one of those rules, when those cases work. Not just say, well, I know they don't always work, but okay, what are the situation when it doesn't work? Well, one of those situations is when the Fed is tightening. Okay, don't fight the Fed. So that's the whole thing. Is people make money. The ones who make money are the contrarians, the ones who go against the grain at key turning points when too many people are on one side of the boat, and things are going to shift. That's what we did in the oil stocks last year. People done very, very well. I got a call out of the blue from Carl Icahn. I swear to God. I mean, you can ask him, and he just said, "I heard what you say on Bloomberg. I love what you're doing," and now I chat with him every once in a while. So it's this is what we're trying to do. Think outside of the think outside of the envelope. We're here, those old sayings get old, but I'm telling you, that's where the money is made, especially in active trading. It's not just getting on a chat room with 10,000 other people trying to figure out which ones are trying to help you and which ones are trying to hurt you, or which ones don't know what they're talking about. So again, my thing, and again, I'm not going to keep taking shots at others. I just think we're here to make people,
yeah,
educate people and help them make money. But really, again, whenever you're doing anything, once you get good, I don't know if I got a camp counselor who taught horseback riding, and he said you can't enjoy anything until you're good at it. And we're not going to say, wait a minute, you're supposed to be. It's not, it's not who wins or loses. It's how you play the game. And he retracted. He said, that's not what I'm saying. I'm not saying you have to be great at it, but you have to be at least proficient. You have to know what you're doing, or you won't enjoy it. I mean, how many people try to take up skiing or golf at age 50? It's just too hard. I mean, some people can do it. Don't get me wrong, but it's harder. Okay, but once you get proficient at it, it becomes much more enjoyable. You do it more, you get better at it, etc. And that's the same thing here. Just don't just throw yourself on the slopes and hope you can figure it out. Go there where you can actually learn what's going on, and not just from me, but from all these other people on the site that are trying to help each other.
Yeah, and D Ray is on the YouTube chat, just puts like a brain emoji. I like this man. So compliments there to Matt Maley. I agree. A lot of his members love him too, right? I mean, guy's smart. So all right, we have one here from SPT stock INTC Intel.
Yeah, Intel. This is a.
And just to recap, guys, what you're seeing Matt do right now is what he does in the chat room all day. Whenever you guys maybe ask about a ticker or feedback on your trades, he pulls out his Bloomberg terminal, which is not available for retail guys, because I see you guys are asking in the chat. It's only for pretty much equity funds, and Matt Maley has access to this. And if he finds things that are interesting, things that pop his eye, he will bring them up in the chat. If it's something interesting, he's done that before. These Ford, like right now we're covering Ford. Like 2-3 months ago, there were some Ford calls that went up like 200%, something like that. I know we're showing you recent trades, but I've been here for about a year or so, and I can tell you, Matt says they're not very common. I understand that, but like I see them very often as well on my end, and people give me the feedback. So, you don't have to put your whole house into these calls, but yeah, as long as you're more right than wrong, you'll end up on the winning side.
Right. And now here's on Intel, and I totally agree with you, Rodrigo. Intel, see the stock, a nice little breakout here. That's good. So, and the new CEO is very good, and but it takes a while to turn an ocean liner, and he's trying to do it, and I think he will. And everybody I talk to, the really smartest people on Wall Street, really like this guy, but it's going to take some time, and. But on a technical basis, it's broken above its trend. It's this trend line going back to last March, but it's bumping up against its 200-day moving average. See that? It was key support. It bounced off it there. It bounced off it there. It bounced off it there. When it broke it, that old support became new resistance, and it's having a tough time breaking above that. And it's overbought. So I'm gonna hold off on this one. I'm not gonna chase this stock here, but. On a long-term basis, I think you can go ahead and buy it right here. These guys, the United States absolutely positively has to get into the manufacturing of chips. Okay, Intel got out of that business. Big mistake. They are going, and this new CEO is getting back into it. We cannot right now. We are relying on Taiwan, and if something happens between Taiwan and China, the world has a big problem, and they are going to do it. They are going to get help from the government to do it. They're going to get, whether it be subsidies or whatever they need, they're going to get. It's going to take time. They can't just do this in 6 months. As I said earlier, it's like, well, they can just turn things around. And for some companies, yeah, you can build a new factory and get it up and running in 6 months. This is going to take a couple of years. But these guys are doing a lot of the right things. It's been a dead dog stock, but it does remind me a lot of Microsoft. About 10 years, how many years ago, with Mr. Nadella came in and took it over. It's been a great company. It had went through a decade of very tough time. Then it did very, very well. And then this new guy came in, Mr. Nadella, who's done an unbelievable job. And I think Intel has the same potential to really turn this big ship around. And the same thing, of course, happened in Apple Computer way back when. That was different because Steve Jobs left, then he himself came back and ran it. In the case of Microsoft, it wasn't Bill Gates coming back, it was a new person coming in, but he did do it. The same thing is happening here with Intel. So this is not a stock I'm chasing here because it's overbought on its RSI chart. And it's also, it's had a great run here over a short period of time. And it's also bumping up against a key resistance level. I think it probably pulls back, but I do like to nibble on it here. And then you can, this will be a buy the dip stock throughout the year. And long term, I think you're going to really like this one because, like I said, they have ability more than most to ramp up the production in in the chip manufacturing area for the U.S. And not only do they want to do it, but the government wants them to do it, and so do all of the people who put chips in their products. And guess who that is? Pretty much everybody, whether it be the auto industry, we all know. I mean, it's the chips is like, the chips are the next oil, as they say. One of the biggest problems we had, of course, for several decades is that we became so dependent on oil energy from other sources, especially OPEC. Well, guess what? Now we're doing the same thing when it comes to semiconductors, and we cannot afford to do that. This stock cannot, just forget about, you see, some things are too big to fail. This one is too important to not succeed. And there's a difference. They will succeed. They will make sure they will succeed. Now, here on the technical basis too, like I said, it's getting overbought very near term. I don't want to chase it. But if it comes back a little bit, it's also bright. This is called a wedge pattern. They call it a declining, it's funny, a declining wedge. You think, well, it's a declining wedge. That must be a negative pattern. No, it's not. Negative wedges are, it's because its nickname is called a declining wedge, but its nickname is a bullish wedge. And upward sloping wedges are nicknamed rising bearish wedges. So it's usually, they break out the other way. They're usually a reversal formation pattern, not a continuation pattern. And so this is broken out of that. That bodes very, very well on a long-term basis. Again, I just think with an overbought near term, facing that 200, that resistance level, it's probably going to pull back. You know, tomorrow, God only knows. Again, if the whole broad market goes up, it'll probably move up a little bit. I think you're going to get a better entry point later in the first half. But there's no round to nibble here. If you're just buying the stock, I'm not looking at the options. Buy the stock here, and then especially once it breaks above that 200-day moving average, and you really get, like I said earlier, don't be afraid to pay up after a stock's moved. You buy that stock, you're going to be very, very happy in the years to come, because like I said, they are too big. They're not too big to fail. They are too big not to succeed. Too important. What they're going to be doing with the chip manufacturing is too important not to succeed. And so this one's going to work really well. I want to mark that down. Make sure I talk about it again tomorrow. All righty. Any others?
Sounds like a good one. I don't know. Let's ask the chat. All right. Let's ask the chat. Do you guys want another ticker here or not? Let me know. Matt is ready to go. He's used to doing this every day on the chat room because, you know, that's just what it is. Let me just go over here a couple questions here, Matt, really quick. Emba asking about the software. Yeah, that's Bloomberg Terminal. It's not available for retail. We went over that.
It's available if you want it, but it's $3,500 a month.
Yeah, we're not going to do that here. Street Perf, this is a good webinar, lots of information. Thank you. Giant Coast, very informative. Thank you. All right, you're welcome, guys. All right, let's see. Software, we just went over that. Let's see. I'm not seeing any interesting tickers there in the chat. I don't know, guys. You guys need to spice it up. I need to see, you know, let's see. No, not GME. Let's come on, guys. Give me something I can work with there. Let's go with Roku. Let's go with Roku, Matt. All right.
All right. Okay. Again, this is like some of the others we had earlier. I'm sorry, but it's again, this is a descending triangle pattern. You can see. And it looks like it's breaking below the bottom end of that triangle. Triangles, as I said, falling wedges are usually bullish. Descending triangles are usually bearish, and ascending triangles are usually bullish. So this is the fact that it's breaking below this, and it's not. It looks like it might, you know, it's not as oversold as it has been at other times. But even then, it's been kind of a straight down. But again, this is one of these stocks that is getting completely washed out. This is going to present an unbelievable opportunity when the market sees a correction, and you know, Microsoft is going to bounce so nicely. These stocks, some of these others washed out stocks that we've talked about, including Roku, are going to skyrocket. So again, I don't mind buying, nibbling a little bit here. I just think it's got further to go, probably get more oversold. And, you know, so it had that then, well, let's see, it had a death cross, but that was a long time ago. That was several months ago. So that's kind of worked itself out. So I'm not worried about that anymore. But what I want to see, hopefully, is it can break back above its 50-day moving average. Either that or get more oversold, more extremely oversold. It's just, it's kind of a broken stock. And you need, when you get stocks that go down and stay down, I mean, it's trying to build a nice base. So don't get me wrong. If it can hold here, and rally back, but it has to hold immediately. It cannot fall any further. But again, I like, this is another company with a great idea, great long-term prospects. It just got too far ahead of itself. And that's why people, when they had, a little too much leverage and stuff. I mean, look, its PE is still 95. I mean, it's, I understand 120 was forward earnings. And I'm not trying to, again, this is so much different than it was in 1999 because so many of those companies had no revenues. They had nothing. They were just shells. And it was ridiculous. These are in many cases, are very good companies. They're going to do fine. So they're going to provide great buying opportunities. I just think until we get that kind of more flush in the overall market, that's going to be a little bit better. But again, it's still very, very expensive, I'm afraid.
Okay, and we have a very special person here, Karina, in the chat, asking about Upstart. What's the symbol? Do you know? Is it UPST?
Yeah.
All right, Karina, this one's for you, okay? So I know you emailed me.
Okay, here we go. This one, boy, this one has been a very interesting one in the chat room because it made some nice money up here. We've kind of stayed away from it here, and I'm glad we have, obviously. But it's been just a series of lower highs, lower lows, all the way down. We got another lower low now. It's getting oversold, but not as oversold as before. It's just like these other ones. It's like Roku. Let me go to the weekly. Okay. So, you can see how it's 50-week moving average. Obviously, the company hasn't been public that long, so the chart doesn't go back very far. But it only has a 50-week moving average. But that 168, but that's $50 above this level. So I guess my point is I want to see it get more washed out on more washed out on a technical basis. And again, expensive stock, 60 times forward earnings. I think that's this is one, I mean, again, what is the future? Cloud-based artificial intelligence, okay? Artificial intelligence, cloud. What's bigger than this decade? Nothing. Maybe they'll come up with something new that I'm not aware of yet. But the cloud computing and AI are the future, not just this next decade, the next couple of decades. So this stock is going to be an unbelievable one. So I guess my point is, if you like it longer term, don't be afraid to nibble on it here. I just think I would rather see it get a little bit more washed out, and I think you got to get it probably below 100 before it sees a solid bottom. And see what happened here. This is what I like to see. See, on a technical basis, it formed a nice base. And finally, the sellers got tired of selling and the thing just took off. I think we'll see the same thing here. It gets down to 100. It'll probably trade there for a little while, in and around 100, 105. And then you're going to get a great opportunity again when the broader market bounces back after what I think would be a correction. But unbelievable opportunity in this stock eventually. And that's just, it's the same thing what happened after the dot-com bubble. Some of those stocks Amazon went down 90%. Talk about a buying opportunity. So I think this is the one we'll see the same thing, but it's just a little bit early, but I do like it longer term.
Yeah, and we just had a bunch of people sign up right now, Matt. So shout out to everybody that just signed up here for Matt's trading room. We have here another one by a very special person as well, Adobe. What are your thoughts on that? And I know it's a macro play too. So
another tough week for one here. Oops, sorry. I don't know what the heck I did there. But hold on. See, now look at this one though. I mean, this is getting washed out. See, now it's really good. Not quite as washed out as it was here. But again, again, people sit there and go, what is with these moving averages? What are you talking about? A 200-day moving average? Well, first of all, it's a round number, but it's almost a full year of trading when you take out holidays and weekends and all that stuff. But see how it got down to the 200-day moving average, got a little below it and then bounced? Well, it got here and went through it. So that old resistance, old support became new resistance, got right up to that level and rolled over. So that this was a great level to make a negative bet if you wanted to buy some puts. However, it is now getting quite oversold, and not quite as oversold as it was, but that's okay. It's like waiting for it to get as oversold as it did in 2020 when the whole economy had all but shut down. You can't wait for that. Now this wasn't then, but let me just give me the Bollinger Bands because it looks like I'm going to guess it's extended there too. Bang. No, it's not quite there, but it's getting very close. I mean, you think 500 certainly should be a great spot. The 500 is going to take it to just as oversold as it was here. It will take it below that Bollinger Bands chart like it did here. So you might want to wait, but see how it got below there? It did stay there for a couple of days and then bounced. But this one, again, on a long-term basis, this is going to work out really well. It's got, it got all sorts of issues going on, obviously, with China and everything else. But it's one where I hate to sound like a broken record because I am cautious on the market that if this one's closer to being washed out than a lot of the other ones that we were talking about, but like Upstart. But it's getting there, and if you want to nibble here, that's fine on the stock. But again, it's a lot of technical damage has been done, so it might take a while for this one to really bounce back. I mean, look at that trend line going back to the March. It's below that. I'll take this Bollinger Band chart off. Bang. There we go. You can see that it's not only below its 200-day moving average, but you go back and of course the key starting level for many charts, of course, is the March 2020. I'm sorry, 2020 lows when the pandemic lows. You see that we broke below that. We tried to get back above it. Now we're well below it. A key lower low. We want to get this stock probably get more oversold, as oversold as it was in September, but that's going to provide an unbelievable short-term buying opportunity, just like it did there. And I think for a longer-term opportunity as well.
Okay. All right. So we have one here for Vincent. He's been really popping there in the chat, I see. So Mr. Vincent, what do you have here? He's looking at Monster, MNST. All right. Don't worry, Vinny. And then we got Janine's pick. Janine or JC, put your pick on the chat.
Yeah, this one I'm bearish on. Near term, totally based on the technicals. Hold on, 2019. Don't want to overstate this stuff. I mean, there are some reasons to think it will and can't, and this is only on a short-term basis, that is. But look at this. It's got lots of potential at some point later in the year because we're looking at a very possible, what do you call it? I'm sorry, a golden cross. See what happened here when it got a golden cross? It's rallied forever. Here it got a golden cross. It rallied for 3 months, 2 months. So if it gets to that, but I do think it's got to take a breather here. Why? Because look at here. We're going up and it's hitting a resistance level. Once the resistance levels are broken, it's really bullish, but the resistance levels for a reason because sellers came in at this level. And so they're likely to come in again. And at some point they'll be like, uh-oh, the story's too good, or I don't have any more stock left. I'm going to go, there's nobody left to sell and the stock breaks out. However, look at the RSI, okay? Look at it there. It's very overbought, okay? The last time it wasn't even that overbought. Look how much it went down. Here, look at it here. It went down for a couple of months, a couple of weeks anyway. Here it got overbought, down. Here, it just held up and then got hit. Here, went down. So you see when it's at a level on its RSI chart where it consistently gets knocked down. Here it didn't get it. This one it moved sideways, but it really didn't run away. Okay, but this is so good about it is, do you want to buy maybe some puts on this one, especially if the market doesn't rally in a big way tomorrow if we get negative news? This might be a good idea on this one. However, the great thing that we know is that if I'm wrong and this stock doesn't come down much at all it's going to need, all it's going to need is a meaningful break above its that double top high. Okay. And let's just go back in time a little bit, 2019. But you can see this level, a double top level, basically at $99. And people look at the round number, and $100 is good too, because you always want to make sure it's not just a head fake, just a mile. It breaks above $100, this thing is going to run. So I might suggest buying some puts here on a very short-term basis. I don't want to go long yet because I do think it's going to come down because it has every time its RSI chart got to this level. But when it gets oversold, we're going to buy it, and then we're going to add to it when it breaks above 99. The thing is going to, and then suddenly we're going to go, great. We bought a lot at 99. We bought a lot at 93. We got an average price of 96, and the stock's 110, and we're looking pretty.
Okay. All right. And we have my good friend here, Janine or JC, not sure what it is. BIIB. I don't know. Is that like some vaccine thing?
Yeah. 1 second. This one, I mean, well, I hate to say it, but it's so difficult. This is this company's been around a long time. It's not like it's a brand new company that came out of nowhere and they're just hoping to rise to fame because on COVID or something. I mean, they've been around as long as I can remember. I mean, I just went back to 2010. I'm sure it's been around for 30, 40 years. But you can see what I do like about this is it's been stuck in the sideways range for 5 years, okay, almost 6 years. However, it's at the bottom end of that range and it's coming. Let's look at the weekly chart. It'll go all the way back to 2010. Whoops. Why is it not? Oh, hold on. Oh, there we go. Okay. But see this right here above, just above 200. It got close to 200, but it's really about this 210 level, 220 level. And look at this. Look how oversold it come on its weekly chart. Okay. Just as oversold it was there. Look what happened there. Now the stock went sideways for a while before it finally rallied. But here, big rally. Here, well, here it kind of rallied for a little bit, then short term, but then finally rallied. You go back to 2010, of course, it just took off. This is the most oversold the stock has been in a decade. So the thing is, that at 220, that's your stop out level. Okay, that's a 10% loss. It's it's below 240 right now. You buy the stock here and look for it to go higher. And if it breaks below 220, you take your 10% loss and say, okay, I'm going to look at it when it gets more oversold. But this is the most over. It's so tough with these biotech names because they really they can so many. I mean, look at these things. Look at this. This move. I mean, these are 50% moves. These are not. This is not a brand new company where they jump around. It's just been a tough stock. But I think on a trading basis. And I don't know. I have to be perfectly honest with you. I don't know enough about the drugs they have in the pipeline to make a fundamental call on this one. But I do like the fact that on its weekly chart, it's the most overbought it's been in a decade.
Yep. And then
Oversold it's been. I'm sorry.
My friend here, Karina, she already got Upstart, but she's like, "Oh, that's not my pick. I wanted Mara." So look, Karina, I'll let it slide. You'll get 2 picks for the day. All right. Let's do Mara for Karina here.
MARA.
Yeah, that is right. That's right. That's a Bitcoin mining thing. How was she saying she didn't pick? Come on, Karina. We all know.
Okay. Again, this is one where, again, on a technical basis, go back, 200-day moving average, 200-day moving average, 200-day moving average. Okay, great support. It finally broke it. And like, this is trouble. It went back up. It regained that 200-day moving average, but then fell back below it. And to a lower low. That's a concern. However, it's also very oversold, not quite as oversold as it was here, not quite as oversold as it was there. But this is my view on the whole thing on a fundamental basis. But it's actually not even fundamental. It's kind of a positioning basis. Everybody's talking about Bitcoin. And at the end of the year, they're like, why can't Bitcoin rally? I mean, I thought all these institutions came in and bought it, and we all know that at the end of the year, these institutions come in, they try to push up their favorite holdings so they look good at the end of the year. The problem is they push up their big winners and they sell their losers because they don't have much money coming in at the very end of the year. That comes at the beginning of the year. They don't have much money coming in at the end of the year. And so they have to sell something to hold up Apple, which is a huge part of their portfolio. And not only that, we all know that even though the institutions started getting into it in a fairly meaningful way this year, it's still small positions. So if they pushed Bitcoin or Ethereum higher, it's not going to, some big mutual fund guy, it's not going to change his performance for the year. But Apple's 10% of his fund and he pushes that up. I mean, that's going to help his performance. It's going to help his bonus. It's going to help the people who market his fund sell it in the next year. And so that's what they do. So I said, well, wait a minute, though. Still, I mean, Bitcoin had a nice year last year. It was up 75%, even though it came down off its highs. However, we do have to remember that, remember this time last year, all the institutions were saying, the institutions still hadn't gotten into it. That was one of the big bullish stories. It's like, wait till the institutions get in. This thing is really going to take off. And a lot of them are saying, yes, we do have to get into it. And sure enough, they did. And sure enough, it pushed it higher. However, they got in the spring, late spring, early summer, and therefore they lost money. At the end of the year, they're down, either flat or if they're up, only up slightly. And again, since it's such a small part of their portfolio, they're not goosing that. They're like, get that off my books. I don't want that. Sell that and buy Microsoft so my portfolio looks better. But now the year's over. We're into a new year. Now, we know, obviously, the first couple of days we do need the thing to stabilize and bounce back. But I think, especially Ethereum, which I'm more bullish on, and on these miners, once the institutions are like, okay, we need to be in this asset class. And I know I sold at the end of the year last year, but I can't walk away from it. I have to have some exposure, and I'll probably need to end the year with more exposure than I did last year, especially if it's up. So they're going to start coming in soon, in my opinion. And talking to my institutional customers, and again, it's just anecdotal. I can't say I did a big, scan, a big polling of them, but I did anecdotally. They're saying, "Oh yeah, that's exactly what I did. I sold some because it just wasn't. It was I had in some cases I had a profit, I had a small loss. I just just got rid of it and focused on my other things because it's the end of the year. And all these institutional traders at the end of the year, they do become short-term traders, no matter what they say, because again, they want to make sure they get the absolute most they can at the end of the year to help their performance. There's only so much they can do with a couple of weeks left, but they do it. And so I think that these people are going to come back into this thing again. If the overall market gets hit over the next couple of weeks, we could see another flush. So, and again, this isn't quite as oversold as it was, but this is one you start nibbling here, buy a little bit more when it nibbles down, and then when it breaks back above that 30, well, it's 200-day moving average, which will change over time. So make sure you keep an eye on that. And you don't just have that Bloomberg, just see 200-day moving averages. Pretty much all services will show you that. And it breaks back with it, then you really, then you have the confidence to buy even more, and the thing takes off. So much of most technical analysis will say, we want to catch the thing in the middle, the 70% in the middle. For me, I like to look when things get really washed out. But the point is, so many people in our business don't have the guts to try to buy a little bit lower, and that's fine. But the real people who make a lot of money have never been afraid to pay up once they have a position in something that they believe in, and are not afraid to add to it, and sometimes add to it in a big way. Because yeah, geez, I would love to be able to say that I bought the stock at 20 and it went to 100, so I had 80% gain. Well, I bought it all the way up. Now I only have a 65% gain. I can't brag as much. It's like, yeah, but guess what? You have a boatload more money because you own more of the stock. Who cares about them? And believe me, if you can claim you're up 65%, you're still going to look good. So don't be afraid to do that. And this is one where I think you're going to be later this year. And I'm not saying the end of the year. I think we'll see a nice resurgence in the cryptos, and start buying now. Add a little bit if it drops a little bit more, and then when you break above the 200-day moving average on this one, you really want to pile it, really get into the stock.
Yeah, a couple things there, Matt, that I don't know if everybody catched it when we first started, but yeah, what you were mentioning, that a lot of people on, let's say major networks, or that they do get paid to be bullish, and instead what you are doing, what you provide with Benzinga, is something that there are certain advantages that I guess institutional traders have. There are some that retail traders can have sometimes, right? I think this would fall under that category, right? Where you would have someone from Wall Street that pretty much breaks it down to you, because otherwise, if you're just, reading, watching the news, you're going to be pretty hurt if you trade around that.
Absolutely. And then especially at those key turning points, when everybody gets on one side of the boat, and it's just human nature. I don't want to overly blame Wall Street for being, perma bulls. I mean, but sometimes people get overly bearish, like they did in oils a year ago. And it's just like, there's nobody left to sell. This is an easy buy. And the same thing with people with too enriched on the buy side. And you need somebody, because it looks just like this thing's been going up forever. It's got to keep going. Well, you need somebody to tell you, actually, no. Or yes, yeah, boy, it still has plenty upside. Keep going. That's why I said with Apache, it's gone a long way up. Chevron's gone a long way up. I think it's got a long way to go. And I think this one will have a long way to go, especially after it breaks out there. Yeah, you need, I just think you try to at least level the playing field a little bit. And these guys have armies of analysts, and it's just tough. It's a tough game to play if you don't have the experience.
Right. And I know you mentioned Ethereum. I mean, to me, it's recent. I mean, pretty much somewhat recent that you are, very bullish on Bitcoin and Ethereum, but mostly on Ethereum. Why more on Ethereum than Bitcoin?
Well, I mean, and it was funny because when it did top out, I did because when the Fed got much more hawkish, I said, we got to be careful here, and so I got more neutral for a little while there, and I still am right now. And with you see Ethereum again, 200-day moving average looks like it wants to fall a little bit before, but it's not fallen anywhere near as much. And the reason why I like it, it's got a lot more. Look at the RSI; it's getting oversold. Not quite. Well, it's pretty close to being as oversold as going to be. Boy, this looks like a good boy. Ethereum looks like a good play right now. But I'm gonna write that down. But ETH, okay. Anyway, but they have, it's more than just a currency. And with their blockchain advantages, it's just so much more uses. It's this whole thing. I was actually asked about coin today, the stock, and on CNBC, and I said, I talked about the same thing about I thought how the stock's going to go. I'm sorry that the institutions once they get back in it will take the thing higher. But one of the things that I also pointed out is that they have diversified. They're so much more diversified than just Bitcoin, and certainly not just cryptos. And they're getting a lot of traction in these other assets. And this is exactly what Ethereum's doing. And they have more uses than Bitcoin does. So I think that especially, I guess my point is, if you talk about the worst case scenario, if the government really starts to clamp down on for some reason or another, like China has. I'm not saying that's going to happen, but if it did, Bitcoin is going to be in big trouble, or Ethereum, which has so many other uses, is going to be in much better shape. So I'm definitely like Ethereum a lot better, actually. But I'm still bullish on Bitcoin as well. And I think as people are saying 100,000, it's very doable this year.
Okay, all right, Matt. So I know that we've been here for quite some time, and just want to know how you are with time here.
Yeah, I think we'll try to wrap it up here. I get some dinner here at home, so I'm going to try to get out. But I hope this was informative for people and helpful. It's again, I'm not, the key thing I want you to know when I'm talking about with this thing with the market and being concerned about whether it be the Fed or just the tightening in China, that we have a tighter policy. And it's not because these guys who say, I get these headlines for people selling market letters saying, American crash 2022, and that's not what I'm trying to do. I'm saying it because I truly believe that this change in policy is going to create volatility and create opportunities. And it's kind of a unique time. I mean, I didn't, it's not like, oh, geez, whatever it was 6 or 8 months ago that I said, okay, let's start a chat room because I think the Fed's about to tighten. Although I did think the Fed was about to tighten, but I love talking about the markets. I'm very passionate about the markets. I love teaching. I hope you'll come along. I think you can really learn a lot, and not just from me, but from others. And whether it be about options, timing, technical analysis, positioning, which is so important. Again, positioning, people, it takes a while for positions to get the technical analysis. We can have a couple of many ideas in a certain day. Positioning takes time for it to get really extreme on either side. But when it happens, it's one of the best ones out there. And so that's why we're, again, I think this is going to provide some unbelievable opportunities to maximize returns and not just weather this year's storm. We're going to do much more than that. We're going to profit from it. And that will give us unbelievable confidence to really take advantage of the next bull market when it comes, which won't be long, because we all know, with very few exceptions, and even in the 1930s, the stock market, bear markets don't last very long. And people say, well, it lasted all throughout the 1930s. It actually didn't. The market crashed for a couple of years, from 29 to 32. Then it rallied strongly to 1937, but the economy stayed down. But it rallied very strongly. And those who didn't lose their shirts made a lot of money. And then we had another mini crash in 37, and then we came to World War II. But my point is that like anything else, people, it's human nature. They buy gradually, and when they get scared, they panic and they get out immediately. And that's why bull markets last a long time and nice and gradual, and bear markets tend to be quick. And again, also involves forced selling, and that's, again, it creates unbelievable opportunities. Remember, Warren Buffett is sitting on record. Look it up on the internet. Record levels of cash, because he knows that the Fed has just kept this thing up, and they can't keep it up forever, nor do they want to keep it up forever. He's going to come flying in and with his big pile of cash and buy stocks hand over fist during the next big downturn. And we want to be able to do the same. But if you don't have cash, and if you're leveraged, you're going to be selling when an unbelievably great buying opportunity presents itself. So I hope you consider it. Those who have joined, thank you so much, and good luck with everything. Have a great weekend, and do watch tomorrow. Watch those things. Watch that number tomorrow, and don't react immediately. The markets will probably jump around a little bit, see how things settle in. But I do think some of the bond market is ripe for a sell-off. I'm sorry, which for a rally, which will cause rates to go down. And some of these tech stocks, you might be able to get some nice little lottery tickets to buy in the Microsofts and the Nvidias and Microns of the world, where you can make some nice money on a very short-term basis. That's all I got. So thanks a lot, everybody, and we will. Hopefully we'll see you on the chat. For those who've joined up, we will see you on the chat. So I'll leave it there. I'll hand it off to Rodrigo.
Yeah, absolutely. I'm going to stay here, just going over the chat room, showing it to you guys really quickly. Matt, just want to say thank you here for joining us today, for going well over, the time and everything to, explain everything. So I appreciate it. Everybody in the chat room as well is saying thank you very much. Very appreciative. So thanks a lot, Matt. Appreciate it. This was great
My pleasure.
for everyone here.
The markets are great, and there's so much, and they're fun. They can be very frustrating at times, but they're always changing, and it's just it's a great exercise. And again, it's just like anything else. When you know what you're doing, when you know more about what you're doing, rather than just taking guesses, it's a lot better one. So have a great one, and have a great weekend, everybody.
Okay, sounds good. Thanks a lot, Matt. And guys, I'm just going to show you the chat room really quick. If you have questions about like the actual plan here with Matt Maley, where his trading room right here that you're seeing, there's a scanner there on the top right. Right here, where it's zoomed in. You have the some of the prior recordings here, and on all of the other webinar sessions as well. You do have those available. You have trading view charts as well here included. You don't have to pay for this. It's included in the chat room. And here, as you can see, everybody's just talking with Matt. EP is asking, is this a different chat room to the Benzinga Pro chat room? Yes, this is a separate chat room, separate platform. As you can see, this is, on its own. And there are more things that will be added. This is just pretty much the beginning. There's an upgrade that will be done to the chat room and more tools that will be added. And it's just part of the process here, pretty much. So it is a different chat room. So I'm going to post a link here, guys. If you have questions, put them in the chat, and I'll just leave the stream running for a bit. If you have questions, I'll leave a contact there as well in the bottom, guys. Yeah, good session. Matt was very good. Matt's very sharp with the stuff. Yeah, you guys get a free laptop. It's available till midnight. KSACA, yes, you still have access to the other content. What content specifically do you mean? The prior webinars, like the prior sessions that Maley, Benzinga, what? Okay, let me know which type of content specifically, because you do get access to all of Matt Maley's prior sessions, just like this one, pretty much. We've, there's a bunch that he's made. PE, yeah, I need to zoom in. It's just because of the screen that I'm sharing it that it looks like that. But you can see right here, QQQ. He's talking about the triple Qs here, saying that he's holding calls on this. SPY, January 7, $370 calls look good for a lotto. All right, let's just keep that in mind, okay? And he labels that. He says here for a lotto. So people are talking about Microsoft calls as well. So there's different trade ideas being thrown around. Like, I mean, SQQQ as well. So yeah, people are trading the Qs here a lot from what I'm seeing. Bank of America, PayPal, someone's asking about PayPal. KSACA, yes, you do have access to the general content on the site, correct. Value, so it's not the same, it's not the same as the Zoom. No, it's separate. The Zoom call, no, today is not, today was not the Zoom call that he does with his members. That is not on YouTube. That's pretty much just a separate call that he does with the chat members. It is done in Zoom, but you still have it in the chat room. So let's say in the chat room, he'll, for example, he will post, or we will post the link to access the call, and then you join the call live. And then if you need the call, we send it out as well. We can send it to you as well by email, the call. The call is on Tuesdays at 12:30. Yeah, Karen, 12:30 on Tuesday. And by it, yes, I believe it will be sent. Yes. You're welcome. You're welcome, guys. Do people hang out in Discord? No, it's not a Discord. I mean, you can see it. It's not a Discord. This is Benzinga technology, basically. There's coders, developers that pretty much built this and continue to build on top of this. So it's Benzinga technology, and that's why, we have to create these tools for you guys, like, the scanner right here as well. Daily value, I mean, I can scroll a little bit for you so you can see. I mean, we're talking about a bunch of trades right now. AEHR, someone's talking about that. Microsoft, PayPal. People trade the Qs a lot in the chat room, I'm seeing, which is tech pretty much, right? Growth, you could say. So, I mean, if most people end up owning those kind of stocks, so you eliminate the individual risk by trading that. All right, let's see what else they're trading. Cisco, someone's talking about Cisco there. Does he post charts? Yes, Karen. If you ask him for a chart, he will more than happily post a chart for you with his analysis. And in the call on Tuesdays, he can review it as well. You just have to, bring it up in the chat room. Like, hey, Matt, can you review this? Can we review this in the call today or, tomorrow, whenever it is? But daily value, you're going to see people trading calls, puts. I mean, this is everything. The majority that is on the chat room, pretty much people trading calls and puts either on the Qs, on SPY, or, in some individual stocks. And by it, asking if we do sign up for the chat room, do we have access to previous chats too? Yes, everything I'm going through right now that I've been scrolling is still on. It's still today. It's still today until right now. Right now, we just hit pretty much yesterday. So there's no set time. People can be here and, trade information, research, all that stuff all day. So yes, and by you do get access to it. PE, the charts are posted in the chat room. So Matt can screenshot from his Bloomberg terminal and just paste it in the chat pretty much. PE, they're trading calls or options. They're trading options in general, and they're doing calls and puts. They're doing both. EMAT, there isn't, but I can do something for you. Just send me an email. I'll work something out for you. I put it on the YouTube chat. Value, so Matt Maley is available on Tuesdays only. That is on the live call, but he is on the chat room every day, Monday to Friday. It's 9 to 5, but he's been there earlier and later when there are market events that, make it for him to actually be there to report something, right? And how to trade it. That's the volatility that he's looking for. Yeah. So Karen, yeah, the chat room is live. The call is live as well on Tuesday. Everything's live in the chat room. The chart's on the bottom as well. This scanner can be delayed up to 15 minutes though. You can see it right there. Someone's talking about Roblox, UPST. Someone talked about UPST here, but you can see that people were already, talking about this yesterday. Affirm. Someone's talking about Affirm. I think Affirm is really good. Whoever bought it today on the dip today, very good, very lucky. Yeah, so Smarty Trousers asking, how do you log into the chat room? So once you sign up, you're gonna get a welcome email, and it's gonna have all the information you need. You click there, it takes you right away. You'll be where pretty much, you'll see what I'm seeing right now on the screen. The scanners, everything's included. And just make sure that after you sign up, you get an email that says laptop delivery, something like that. Just open it, you fill out the form. That's the address, whatever address you put, that's where the laptop will be sent to. So just look out for the email after the checkout, guys. How about some? Yeah, you can in YouTube, you can adjust the settings. All right, guys. So I'm going to I'm going to drop the link here. I'll drop the contact, and any questions, just reach out. I'm going to leave the stream running here for a bit, and just reach out if you have any questions, guys. Thanks a lot for being here with us today. We appreciate it. K-Saka, there's a 7-day money back guarantee. So if you don't like it for any reason, within the 7 days, you get all your money back. It's that simple. And Baye, do we have an opportunity for a one-on-one with him when we sign up as well? Well, I mean, the calls on Zoom are live, right? But the chat room is the closest you can get to that, right? I mean, you ask a question, he answers, right? You have a conversation with him, right? So, Karen, the scanner gives you gainers and losers. So either on the bull side or the bear side, pretty much. You see right there. If you want to, short or go long, whichever one. I'm not saying to trade all these. I'm just, you could get trade ideas from there. Just, it's giving you trade ideas and you can put them back in the chat room. If it's, you can talk about it with other people there as well. So yeah, guys, I'll drop the contact. Any questions, send me an email, and more than happy to help, guys. Thanks for being here. And we'll see you guys on the next time.